Thank you. We'll move to agenda item 1B, approval of agenda.
This is Linda Eisen. I move for approval of the agenda.
Second.
Okay, we have a motion from member Eisen and a second from member Lavender. Any discussion on agenda item 1B? I could have Carrie call the roll on approval of agenda vote.
Commissioner Garcia-Richard?
Yes.
Secretary Romero?
Yes.
Treasurer Eichenberg?
Yes.
Peter Frank?
Yes.
Linda Eisen?
Yes.
Harold Lavender?
Yes.
Lee Rawson?
Yes.
Mike Messina?
Yes.
And Nick Tejas?
Yes.
A unanimous 9-0 approval of the agenda.
Thank you. With that, we'll move on to agenda item 1C, approval of the minutes from our last meeting, August 25th.
This is Linda Eisen. I move for approval of the meeting minutes.
It's Harold. I'll second.
Okay, I have a motion for approval of the August minutes from member Eisen with a second from member Lavender. Any discussion on this motion? Okay, with that, we'll take a vote on the motion to approve the minutes. If Carrie could call the roll on that vote.
Commissioner Garcia-Richard?
Yes.
Secretary Romero?
Yes.
Treasurer Eichenberg?
Yes.
Peter Frank?
Yes.
Linda Eisen?
Yes.
Harold Lavender?
Yes.
Lee Rawson?
Yes.
Mike Messina?
Yes.
And Nick Tejas?
Yes.
Unanimous approval.
Thank you, Carrie. Okay, we're going to move to agenda item 2A, which is the State Investment Officer report by Mr. Noes.
Thank you, Commissioner, and good morning, everyone. I'm going to focus solely on 3 sections of my SIO briefing, which you have in your materials. I'll be covering items A, C, and E, because the others are certainly self-explanatory and there's no reason to take time on those. So beginning with item A, total distributions to the state from the funds over the last 12 months have been $1,024,743,000. Our net asset value as of this morning is shown as an intra-month number by JP Morgan as $28,196,940,000. West Texas Intermediate Oil closed at $39.31 yesterday. As all of you know, New Mexico is traditionally about $4 less, but that $4 has recently been considerably more than that. We don't have that exact number as of this morning. The rig count, which is certainly disturbing, has dropped from 109 in September of last year to 43 as of September 18, 2020 in New Mexico. The tax stabilization reserve balance as of August 31 was $1,258,000,000. And I will now go down to item C, council matters. There's one thing to add to the 2 dates that you've been shown there. As reported in the weekly by Charlie in some depth, Victor Marshall has sued 4 staff members, 1 council member, former Governor Richardson, and Attorney General Valderas personally. The Attorney General has moved to dismiss that action. We will not be going into any more detail on that. It's very concerning. Under external relations, under the New Mexico Recovery Fund, which is being handled by Sun Mountain Capital, as you will recall, just a few things that I think you'll find interesting. They have received 131 applications for loans. They've funded $32 million. The aggregate loan amount in the current pipeline is $120 million, and they're estimating that approximately $70 million at this point will be funded. The Small Business Recovery Act, as you know, is being administered by the New Mexico Finance Authority. The authority has drawn $100 million of the $400 million they are authorized to draw. That has not been exhausted. We do not know when more will be requested, and Brent is following that closely with Marquita Russell at the Finance Authority. House Memorial 9, as you recall, asked us to create a strategic plan for renewable energy investment. That plan has now been submitted to the various agencies that have been interested in participating in putting that together. And we will be presenting that to the Investment Committee and the Council next month. You will be receiving a copy of it in advance of that meeting. Our budget hearing is scheduled for October 29th. Investments and Pensions Oversight Committee will be meeting on October 6th. And Charlie had a recent inquiry from a regent at Western New Mexico University about their becoming a client of the SIC. Madam Chair, that completes my report.
Thank you, Mr. Moise, and I'm going to go to council for questions at this time. Questions from council? Okay, with that, we'll move to agenda item 2B, the Chief Investment Officer report. Mr. Smith.
Good morning, everybody. Thank you, Madam Chair. Good to be here with you again today. I'll be brief here. We've got a full agenda for you on the investment side, in particular, lots of macro and forward-looking information for you today. So we'll be brief here. As everyone has seen, the stock markets have moved to, at least here in the U.S., have moved to new highs and recently corrected that just a little bit. So we hit new highs late last month and moved higher through the first day of this month, and then have had just about a 10% correction from there. Not quite, but just about. Right on cue, the Federal Reserve came in and promised to support the economy and the market with anything they could do. That's sort of halted the decline here in the last day. Today it's up just a little bit. I think it's important to just discuss briefly on what everything we can do means when the Fed says it. Ray Dalio's been out in the public eye here recently. He's chair of Bridgewater Associates, one of the largest hedge funds in the world, and he speaks often. And he's got an interesting and pretty clear way of explaining monetary policy. He says there's three types. Type one is when the Fed cuts interest rates in response to recession or potential recession, and we saw that in 2000 when the tech bubble burst in the stock market. Interest rates were cut from about 650 down to about 1%. And then again, ahead of the great financial crisis, rates had climbed back up to about 5.25%. They were cut to zero effectively. And then just here recently in 2019, when rates had gotten up to 2.5% and were cut to zero as the economy started to deteriorate after that. So that's monetary policy one, according to Dahlia. Two, monetary policy two is when the Fed starts using its balance sheet to purchase assets, and we've talked about this before. Primarily, they do create money, and then primarily buy government securities, mortgages, agency paper. This latest time, they've expanded that into the corporate bond market, where they actually bought less than investment grade jump bonds with this last round. That's monetary policy too. So one, they cut rates. Two, they'll create money and buy securities to try to stabilize markets and liquefy the system. Monetary policy three is concerning, and that's when the Fed creates money and buys government bonds, newly issued government bonds, to support the federal government in deficit spending. That type of monetary policy, folks are very concerned, may cause inflation in the future. That's $7 trillion has gone into the market, partially in that way, here in the last few months to support a weak economy and to support markets here. So we're keeping our eye pretty close on how much is being created and indeed transferred to the federal government to spend. The CBO came out with a statistic, I think it was yesterday or maybe day before, where now more than half of government expenditures are debt, are borrowed money. 52% of government expenditures. That was a CBO figure that I saw in the news yesterday or day before. I'm digging into that a little bit further to make sure that's the case, but it's at that. I share that number with you to tell you that we're at that level in terms of money creation and dollars being spent that way. So we still have this interesting dynamic of the economy still being very weak and needing that type of support to move forward, and markets that are still near their highs, at least stocks, and credit spreads on bonds have still been relatively tight. So we're still in that situation, watching it closely, and we'll talk more later about strategies and things that we may want to employ, based on this environment. But I'll stop there now, Madam Chair, and ask for any questions.
Thank you, Vince. Questions for Vince from the council? Okay. Hearing no questions, we will go to the performance report by Mr. Smith. And who do we have here from RVK?
Marcia Beard and Matthias Bauer from RVK.
Okay.
So in your packet is your latest performance report. I didn't really have much in the way of prepared comments for this one. It's an interim report, so I'll pass over to Marcia and Matthias if they have comments about it.
No real comments. Again, it is a monthly report, so their performance for alternatives is not part of it, but you'll notice it was a good month in July, up 2.79 in total, up 2.85 for the land grant, and 2.82 for the severance tax, and beating its benchmark for that month. It looks like, I just want to say that you'll also notice that calendar year to date, you're still negative at that point, albeit that it was a strong month. If we look at August numbers, we're thinking that you will be positive, be above zero when you see the August report. So we think we've come back. Of course, as Vince mentioned, we've given some of that up again, but expecting positive performance for the month end August 31st. Other than that, again, it's an interim report. Happy to answer any questions.
Are there questions from committee on the July 2020 performance report?
Thank you.
Okay, thank you. We'll move to agenda item 3A. We can hear the investment committee report from Chair Eitzen.
Good morning, everybody. I hope those of you in Portland with RBK are breathing and being able to see out your window. I know you're really caught with smoke there. I'm so sorry for you.
It did rain. It did rain, so we can get outside now without wearing a mask. So thank you for asking.
Oh boy. Well, let me go ahead and give a report on the investment committee. Again, I am so pleased that Commissioner Garcia Richard attends most of our meetings, which I really appreciate and urge anybody else to. We discussed quite a bit in depth, and this meeting is a very important meeting because all of our other meetings and all of our other investments are based on what we look at and decide upon today. This decision regarding asset allocation, targets, total risk tolerance for the portfolio, intergenerational equity, all of these are the important things in the foundation upon which all of our decisions are made regarding investments. So this is a very important meeting, and I again urge anybody to attend the investment committee meetings who possibly can. We did approve the Brookfield renewable sidecar unanimously. I think everybody will find that that's an interesting investment, and we had a number of questions and clarifications, but we did approve it unanimously. As far as the strategic items, those are again the really important items that we'll be discussing today. We had fairly in-depth discussions regarding those, and I think that RVK and Vince will do a super job on discussing how we arrive at these numbers, what they mean, and what that means for what types of investments we will be looking at. We also discussed the challenge facing asset allocation, targeting a total fund return, and valuing the total portfolio for the severance tax due to the almost 12% of the severance tax being transferred to other agencies for investment, management, and valuation. That's going to be an ongoing problem, I think, and we are considering relooking at these issues as we get more guidance from the MFA on how these investments might be valued, reported, and performed. But in the meantime, it makes it very hard for us to know how to allocate the remaining portion of the portfolio, since so much of it we have no control over. We also discussed the assumptions for both land grant as well as severance tax as far as contributions from the land office. As they go over it, RVK will tell you how they compute those assumptions and the extra weight that is given to the recent contributions from the land office, and that these computations were done in March when we hadn't seen the severe reduction of contributions from the land office. So it makes it very difficult for us to really look at what we think will be the long-term contributions from the land office. And as you'll see in the material, if those assumptions end up with different scenarios, the intergenerational equity reacts very strongly to any of those assumptions differing. So that's an important item. That's primarily the discussions that we had at the investment committee, and I look forward to everybody's participation in today's meeting on these important matters. Thank you.
Thank you, Chair Eisen. And I'm wondering if there's questions at this time from the council on the minutes from the committee, the investment committee report. Hearing no questions, we will move to agenda item 3B, which is a vote on the Brookfield sidecar investment, our only investment vote today, and I will turn it over to SIC staff and Townsend. Mr. Chapman?
Thank you, Madam Chair. Just doing a sound check. You can hear me?
Loud and clear.
So on the phone today, we have Jack Koch, Seth Marcus, Andrew Bradley from Townsend. We've got the rest of the real asset team on the line. Clay Camper and Nino Carpenito. We're joined by Chris Harris and Sachin Shah from Brookfield. Before I turn it over to Seth, I'm just going to make a couple introductory comments to put this recommendation in context. We're recommending a $75 million commitment to the Brookfield Infrastructure Fund for Renewable Power Sidecar. The sidecar provides investors in Brookfield Infrastructure Fund 4, and you may hear me refer to that as BIF 4, with additional exposure to renewable power assets. BIF 4 is a $20 billion diversified infrastructure fund that aims to invest 20% of its available capital in the renewables sector. And the renewable sidecar will take its pro rata share of those investments. We already have a $100 million commitment to the main fund, the BIF 4 Infrastructure Fund. In addition, we have a $50 million co-invest set aside to invest alongside certain investments in the BIF 4 fund. So the proposed additional commitment of $75 million could bring our total exposure up to $225 million to this fund. The sidecar is going to focus on acquiring a diversified portfolio of value-add renewable power assets located predominantly in the Americas, Western Europe, and Asia Pacific. And I know Sachin and probably Seth will want to touch on the strategy in more detail, so I'm going to leave that. But I just want to remind the SIC members that we have a 12% allocation to turn. 80% of that, or 9.6% of the fund, is targeted to real assets, which is, in our portfolio, is timber, agriculture, energy, and infrastructure. With our timber and agriculture portfolios really built out to the level we want them, staff is focusing on diversified infrastructure investments and on the renewables subsector of the energy sector. Between our infrastructure and energy portfolios, we have about $250 million worth of renewable investments, which is about 14.5% of our real asset net asset value. Although we only have one dedicated renewable strategy currently, and that's the BlackRock Global Renewable Power Fund 2. So given the fund attributes, portfolio fit, conviction of their platform, staff believes that proposed commitment to the BIF 4 sidecar is appropriate for the New Mexico State Investment Council real asset portfolio. So from here, we're going to go to Seth quickly, and then Seth will turn it over to Chris Harris and Sachin to talk in a little bit more detail and address any questions you have about the fund. Seth?
Thanks, Paul, and thanks, everyone. This is Seth from Townsend. I hope everyone is doing well. So I will keep this brief, given Brookfield has the presentation within your materials. But as Paul mentioned, this commitment to a sidecar is alongside the main fund, Brookfield Infrastructure Partners 4, which is a $20 billion diversified infrastructure fund that includes an allocation to renewables. So maybe just briefly addressing the structure of our investment memo and the sidecar here. The terms, the team, the sponsor, the attributes that we've highlighted in our prior commitment to Fund 4 all apply here to the sidecar. For that reason, our recommendation is a bit shorter than a version we typically provide. However, it's the full Fund 4 recommendation is also included for your reference. The return targets mentioned in the materials is a 10% net IRR and a 5% distribution yield with a 2x multiple. All are consistent with the main fund, given the investments in the sidecar will also be owned by that main fund on a pro rata basis. Given the target size of this sidecar, renewable sidecar, the split on any transaction will be approximately 91% of the value being allocated to the main fund and 9% to the sidecar. So because we've all committed $100 million to the main fund, we'll already have exposure to the renewable investments being made. Our commitment to the sidecar will just really increase that on a more direct basis. So the quick math is if the main fund invests 20% of its target into renewables, the SIC will have a $20 million investment in the main fund, plus the $75 million being discussed today. So we had a brief discussion on this structure at the CIC. So we're maybe just to make a to answer any questions up front and maybe to keep it a little straightforward, the sidecar fund is really an opportunity for investors to make 100% dedicated renewable commitment with Brookfield, and offers investors a really way just to increase that exposure. It will invest in every renewable transaction the main fund invests in, but as you may see in our materials, the main fund will also invest in transportation, utilities, energy, data centers, and fiber networks, as well as renewables. So that's really the structure of the vehicle. The $75 million commitment to the renewable sidecar will represent the SIC's 12th infrastructure commitment, dating back to 2012 when the inception of this portfolio. That's across 8 different managers, and this is the 4th infrastructure commitment to Brookfield. So we're invested in Brookfield Fund 2 in 2013, Brookfield Fund 3 in 2016, and the Fund 4 that we've been referencing just last year. When we include all our other Brookfield commitments across real assets, this is a 7th commitment to the Brookfield firm. So that's the 3 infrastructure funds I just mentioned. We have a commitment in timber, in agriculture, and also in energy. So in total, this exposure to, or the commitments to Brookfield total $535 million, or about 17% of New Mexico's real asset commitments. While this is the highest exposure we have to a single firm or single manager, it's well below the 30% limit in our documents, and it's also diversified across those 4 sectors I mentioned. Lastly, Brookfield is also approaching a point in time when they'll start realizing investments from earlier vehicles. So we don't anticipate that $535 million of commitments to be fully outstanding as we receive distributions from realized investments. Lastly, from a portfolio construction standpoint, this is from an investment pacing perspective. This is Townsend had modeled in about $325 million of commitments to 2020 vintage year within the real asset sectors. This is $280 million already committed to across 3 funds, approved and committed. Therefore, this commitment will put us slightly above that target for the year, but does not impact the portfolio significantly from a pacing perspective, and most importantly from a compliance perspective. We remain in compliance and well within those compliance numbers. As I say this, we are. I do want to let everyone know we are evaluating one additional infrastructure commitment that may be in front of you either next month or the month after. Moving briefly onto the fund before I hand it over to Brookfield directly. This is an asset class and strategy that Brookfield is familiar with, has a strong team built around it. We believe Brookfield has the ability to and expertise to really execute on large-scale, complex deals, really separating itself from many of the peers to also targeting renewable strategies. The primary strategy is investing in brownfield, which is operating assets with higher growth potential. This will comprise 85%, maybe 90% of the fund, with the balance invested in more greenfield, which are more opportunistic development investments that could present additional upside. The target sectors really include hydroelectric, solar, wind power generation, and battery storage. The Brookfield team expects to see more growth in both wind and solar, focusing a large portion of their time and capital in these technologies. Lastly, before I hand it over to Brookfield, and I won't go through these individually, but no investment comes without potential issues, concerns that we've outlined in our memo. However, we believe these are very well mitigated by Brookfield's broader track record as a firm and also the existing transactions that help diversify the fund from day one. I'll stop here and hand it over to Brookfield. I will mention, like all investments that we've brought in front of you, this investment has been brought through Townsend's investment committee on a standalone basis, approved on a standalone basis, as well as on behalf of New Mexico SIC. So with that said, I'll pass it over to Brookfield.
Good morning, Madam Chair and members of the Investment Council. This is Chris Harris. I'm with Sachin Shah, who's the head of renewable power for Brookfield. First of all, thank you again for having us. We're coming on almost 10 years of a great partnership with the SIC, and I've been fortunate to be around for all of that. So we do really appreciate that. As both Seth and Paul talked about, we are, if not the largest, one of the largest renewable investors in the world. But I think one of the things that we pride ourselves on is we're a fully integrated company, and we're proud of the corporate citizenships that we have in places, including New Mexico. So, just by review, we've got over 200 million in assets in New Mexico, 30 employees. And as it relates to this, we now have 4 renewable, which are solar facilities in New Mexico. So one at the Santa Fe Wastewater Treatment Center, one at Rio Rancho High School, one at Sioux Cleveland High School, and then one up in the Northwest. So, we are committed to New Mexico as well. We appreciate the relationship, and we look forward to growing it more. So with that, I'm going to pass it over to Sachin to talk specifically about the strategy, and then we're happy to take any questions. Sachin.
Thank you, Chris. Good morning, everyone, and thank you for taking the time to listen to our brief presentation on Brookfield. Today, we have over $50 billion of renewable assets around the world, and we've been building this renewable power business out for well over 25 years. I've been with the firm for almost 20 years, and for most of that time in the renewable power business. As Chris said, and I think Seth said before, we do have an integrated firm, and what that really means is that we have 3,000 operators around the world who work for Brookfield and who look after these assets every day. And it really gives us a unique vantage point and an advantage in investing, in that we can enter into situations where assets either require follow-on growth, require operational turnaround, or we can acquire assets that are being carved out from a distressed seller or from someone who needs capital. And we can do so leveraging those 3,000 operators that we have around the world, most of whom are in the United States. Over 1,000 of our operators sit in the U.S. It's our biggest business by far. And it gives us the strategic advantage to be able to run all of our facilities ourselves, manage our health and safety programs internally, work in communities, managing stakeholder relations, work with regulators like FERC and at the state level. And all of that capability both sits in-house and allows us to really expand the business around the world. As was said earlier, we do target returns that are in that 10% net range, 13% gross. We've got a very good track record over the last 20 years across all of our funds, and you can see that in the presentation. We really spent the last decade diversifying from a technology perspective so that we can offer a broader service level to the markets we're in. So today we invest in wind, solar, storage, both pump storage and battery storage, hydro, mostly run-of-the-river, low-impact hydro across our portfolio, and then distributed generation, which for those who don't know, is really the examples that Chris gave, for example, the high schools in New Mexico, where we provide schools, hospitals, small businesses, localized power on site, typically from solar panels. And that business, as an example, we started 3 years ago, and today we would be the second largest distributed generation business in the United States. So we really do put a lot of scale behind our investments, and we build out operating teams so that we can deliver strong returns. The other thing, obviously, that's a huge theme around the world today is decarbonization, and global electricity grids are working through energy transition initiatives and in looking to decarbonize and move away from CO2 emissions. We're proud to say that in our portfolio today across the world, we help avoid 27 million metric tons of CO2 annually. And to put that in perspective, that would be like powering the entire city of London in the UK with just renewable power. It would also be the equivalent of taking 5 million cars off the road every year, year in and year out. And so we use these examples just to contextualize the size and scale of our portfolio and the commitment we make to decarbonization around the world. And for us, at the end of the day, it's a privilege to be able to invest in this sector, generate great returns for our constituents, but also contribute to what is a pretty meaningful initiative around the world in terms of lowering emissions and helping reduce greenhouse gases over time. So maybe with that, I will pause and open it up for questions.
Thank you, Mr. Shaw and Mr. Harris. At this time, we'll take questions from council members for either our SIC staff, Townsend, or the representatives who join us today from Brookfield. Questions from the council?
This is Lee.
Member Rawson.
Really a question for staff on this, maybe Paul, is on page 51, we're showing that the infrastructure section, sector diversification, this being already energy is 50%. Plus, we get most of the money into the permanent funds from energy. And I'm just a little concerned. I thought maybe you could comment on whether or not you seem to think we're a little heavy on the energy side here compared to maybe communication or utilities or transport or something else. But this would just further make that energy commitment even larger.
This is Paul speaking. So I think what you're going to see with our portfolio as we continue to build this out is we're going to have a shift away from the conventional energy sources and more towards, and that's our upstream and midstream assets, and more towards renewable energy. And as I mentioned earlier, we really only got $250 million currently invested in renewable energy investments. And those arise both in our infrastructure portfolio and our energy portfolio. So you sort of have to mash them together to really have a look at what our renewables exposure is. But this is, it's a very important area of the energy transition. It's also a very important investment opportunity with literally trillions of dollars of potential investment here as we build out to a renewable energy future. So I think it's always going to be a really big part of our portfolio. I don't think at $250 million today, it's too big. You might question whether we've got too much energy exposure in the conventional side of things, and but those are going to tail off. Some of those legacy investments that we have are there's not a lot of liquidity there now, but they will tail off eventually and roll off our portfolio, and many will not be renewed into follow-on funds.
And why the push towards renewables?
Well, like when you think about somebody like Brookfield, this is an opportunity for us to earn really significant investment returns. This fits into the value-added space. So, the returns are attractive. They're consistent with our overall fund objectives. So we just think that this is a good space to invest in terms of risk mitigation. Renewables have performed very well through the COVID crisis. If you look at a lot of other sectors like transportation, airport assets, railroads, and things like that have not held up quite as well, but renewables have. So we just think there's a lot of downside protection with renewables. There's also, with renewables, we really have to be careful where we invest, and this may be a little bit off topic, but it's a very, very competitive space. If you're just buying completed operating renewables assets, it's very hard to get returns that are attractive. Brookfield's strategy is really differentiated because they are geographically diverse. They invest all around the world. They look at opportunities to add value, expand EBITDA through add-on acquisitions and performance enhancements and things like that. So we just think they've got a good track record and good performance to deliver the returns that we're seeking in our infrastructure and our energy portfolio.
Okay, another concern I have is the investment in China. And the Fund 4 already has investments in China. And you got the whole geopolitical issues. We got this whole pandemic type issue, and it seems that there's 20% committed, or not committed, but projected for the Asia Pacific area. And I'm wondering what Brookfield is planning with regard to China. I think that's an interesting dynamics right now.
Yeah, I think it is. And I think, Member Rawson, I'll kick this over to Sachin Shah to address that question.
Sure, absolutely. So first of all, I would say when we talk about Asia Pacific, the 20% that you referenced there, the vast majority of that, and I would say 98 or 99% of that, is really Australia and India, and potentially Japan, if we can. Japan's just a very expensive market to get into. With China, and you can see it in our detailed report, it's a dip your toe in the water strategy. We have a little bit of a presence there only on the renewable side, and it's largely been to help us get to know the panel manufacturers, which today are largely in China from a solar perspective. And this allows us to make sure that we are at the forefront of development on panels and what's happening from a technology perspective. But by no means should you expect that we would allocate anything meaningful to China. We're obviously aware of the geopolitical issues and obviously COVID, and we're aware of just the risks of a communist nation and what it means from a property rights perspective and a rule of law perspective. So I think I can leave it at that, or I can delve into it further. But that has been our strategy in China for the last 5 years, and we're being very careful.
Okay, thank you, Madam Chair.
This is Peter.
Thank you, Member Ross. And additional questions from council?
Tim has one if you have time.
Member Jennings.
Yeah, I look at this stuff, and while you look at solar and wind and renewables, I just have some issues about when are we investing on the wrong end. We had a problem with the renewables one other time when we had the high winds late at night one night, and it shut down the wind turbines, and then they had to cut off the gas line that went north up to Espanola, so they didn't turn off the electric have to turn off the electric in Albuquerque because it caused brownouts on the gas lines, and so when I look at that, and right now we've had 10 or 20 years of doing solar, a lot of tax credits and everything for solar stuff. And right now, 84% of the world's energy is on with hydrocarbons. There's not anywhere close to the battery capacity to generate one day of America's needs if we had a volcano eruption or something and they closed out the world. So with such a small percentage of the electrical use in the world being in renewables, I know it's politically fashionable to do this now. Wouldn't we be better investing the state money on putting in natural gas plants and stuff like that? Yes, they do use hydrocarbons, but the whole world, solar is not a reliable source that you can count on when you need the power. And it's okay for a little bit of it. I mean, if after 20 years we're down still 84% done by hydrocarbons, where are we? And you turn back around and betting on this small 16% of the thing to get so much bigger, we're not in a place to be betting on the 16% side. We ought to be betting on the 84% side if we're investing the state money on where you can get it. If we invested in natural gas plants, then in New Mexico, if you put one in Farmington, maybe Farmington's unemployment would drop from 25 to 30%. Maybe it would drop down to 10%. And then we'll be doing a benefit to our own people. Maybe if we had some of that gas in some other electric stuff down in Hobbs or somewhere, maybe that could solve some of our other issues that we have there. But I guess when we look about
doing everything in renewables like this, maybe we should really be investing the money that we have to invest on behalf of some of the people in New Mexico to get them jobs, but we can't even sell the gas in Farmington. Some of this gas got down to 10 or 14 cents a thousand. It was down in the Permian Basin on some of my checks. That's what it was, 14 cents a thousand. That ain't much money for gas, and you could generate a lot of electricity. And we don't even have a battery capacity, and we're not going to have a battery capacity. Tulsa can't get one. We're not even going to have a battery capacity to store electricity that is feasible, that won't cause more ecological damage to mine all that stuff than where we are. And I know politically possible, it's perfect to sit here and say, I'm for green energy, and you're a real jerk if you say you're not. But you look at the cost of it and everything else, and maybe that's taking away money from our early childhood education. All those subsidies are taking away money that could be done, used in a better way to help people in a better way. And I understand the value of the environment. I mean, I do. I understand we don't want to mess it up. But maybe we could scrub some of this stuff and it'd be a better investment with less risk and a greater chance of return to the state of New Mexico's residents if we invested in other plants other than renewables, because there's no batteries to hold the power anyway. And that's Member
Jennings. I appreciate those thoughts, and I know that you speak for a profound concern for the welfare of our state and a long background in energy development. So I don't take your comments lightly, but in my own experience, I have seen the robust nature of reliability of renewable energy, capacity of renewable energy, and the low cost of renewable energy just grow, all of that grow exponentially in the past decade. And so I don't know if folks on the call, especially from Brookfield, because this is their industry, would like to speak to reliability, capacity, and just the profound lowering of cost of this energy source that we've seen. But I would love to hear, some of the concerns from our council member addressed.
Sure. It's Sachin here again. So, look, let me start with, I agree with a lot of the comments that you made, sir. First of all, and I'll address them. First of all, we started, as I said, 20 to 25 years ago in this industry, before the word renewable was being used, and candidly, before we even used it. And we got into the power sector simply because we thought we could generate very good returns, given the expertise I talked about, the people that we have employed in the business who know how to run power plants, who know how to develop plants. And at that time, we were investing, on the margins in some gas plants and hydro. And we got into hydro in a meaningful way, largely because hydro plants were built at the turn of the century. They were low risk from a technology perspective, and they were the lowest cost source of power because the fuel cost was negligible. And we liked them simply because the returns were excellent. And in those days, 20 years ago, we didn't have a fund business. So we were investing only our own money. And therefore, we really wanted to make sure we could generate very good returns. As we started to build out this fund business 10 years ago, we made it a point that we would be one of the largest investors in our funds. To this date, we are still one of the largest investors in our funds. We put in 25% on each dollar comes from Brookfield. And therefore, we can look people in the eye and say, what we care about is returns first and foremost. It's nice that we can do good things for the world, and we do care about that too, but we really do care about returns. And with our power business, we've made it a priority to invest into renewables as the cost of those renewables has come down. Subsidies were no longer needed, and where we could invest knowing that the renewable projects that we own can stand on their own economic feet without the need for government subsidies and without the need for what I'd say is, other priorities getting in the way of generating returns. And so I agree with a lot of what you said. I think gas has a very important future to play in the electricity grid because it has embedded storage qualities, it employs lots of people, and it's a resource in America that's cheap and plentiful. I also think there's room for renewables now that the costs have come down, and as somebody else said, reliability has gone way up. And you can see from our portfolio the track record of reliability of those assets, the ability to deliver energy during the day when power demand is high, and the ability to provide capacity products to the grid because these plants can cycle on and off if dispatched properly. And so with all of that, I think it's a balance. And I'd say from our perspective at Brookfield, we've really leveraged our operational capabilities to make sure that we don't go to a race to the bottom type mentality. We don't buy just operating assets that are fully contracted and have no levers to create value. We try to buy projects where we can enhance returns, we can drive margin improvement, we can do follow-on development on the assets, and we can really turn around a project and generate, first and foremost, those strong returns we talked about. But also we recognize that these assets really are a part of the overall energy grid. You cannot run today an entire community on solar or wind. You need storage. A lot of that storage today, and most of that storage in the United States, comes from gas, but a lot of it also comes from hydros. And we do own a lot of hydro in the United States. We would be the largest owner in the United States of low-impact hydro, and we'd probably be the largest non-government owner of low-impact hydro in the world today. So we recognize that a diversity of technology is important. Making sure the cost of these projects is low enough that they don't need subsidies is important. And therefore, we've just evolved our business over time to make sure that we invest once technologies make sense. To your point about batteries, we completely agree. In fact, we don't have a very large battery business today in our portfolio. The few batteries we have, we're really doing as a bit of R&D, and we're not putting them into the funds. We're actually doing them on our own balance sheet just to learn the technology, because they would otherwise require subsidies. They don't actually make economic sense today. They might, over the next 10 years, start to come down in cost enough where they do start to compete against gas plants. And we need to pay attention to that, because if that happens, it does make the life of a gas plant come into question. And so we want to be smart about that. We want to be aware of the implications of that. And we're learning that technology, but we're not expecting batteries to be a large part of this portfolio in any shape or manner. So I'm happy to continue to address those types of questions. But I think in terms of your comments, I would agree. And hopefully you can see that we are aligned when it comes to generating returns for the state of New Mexico. And our approach is a thoughtful approach.
Madam Chair.
Yeah, I would. There's nothing wrong with your presentation. There's nothing wrong with your product, other than the fact that I'm just looking about where we are and the fact there's no battery life. So to me, that makes a huge difference. Thank you.
Was there someone who wanted to be recognized? Was that Member Tejas, maybe?
This is Nick Tejas here.
Yes, Member Tejas.
Just real quick, I just want to share my experience on this topic with the group for whatever it's worth. At Santa Fe Community College, we're actually one of the leaders in the state and nationally on what we're doing with microgrid, smart grid, energy, distributed energy. And what we've done is we've been able to develop, solar array that, generates a lot of energy to the college and do that. But right now, we're working with Siemens Corp to install this microgrid technology where we're able to shift around solar, natural gas to eventual battery storage. And we have actually secured a battery that's going to help us with the continuity of energy for the campus. Now, I think the conversation here is probably around the idea that the battery storage is not enough for large municipalities or counties or large areas, but my experience is we've acquired a battery for our campus, which is really important. Number one, because for the college, we're able to save a lot of dollars around when everything's installed. We planned and financed the ability to save, anywhere from $200,000 to $300,000 a year in utility bill. And the next important thing is reliability of power outages. For our college, we're really excited about it because, there's issues with the grid, the power grid, and when it goes down, it puts everything at a standstill. This is going to have that redundancy to have the ability to have continuity of power for the campus and the students. And, this is kind of a nano type experiment on it, which can more than likely be grown to larger scales and things like that. So, it is working. It's actually happening, and the college is potentially talking about power purchase agreements where I know there's a ton of things that are involved with that, but with the difficulty in revenues for higher ed and education in general, these are some alternative areas of funding for higher ed institutions that we're having to be creative about looking towards. So we do have a battery. We have a switch gear that will be able to switch between that battery storage and natural gas and solar. It's all happening, and I think that for the State Investment Council to be looking at these things, it is a wise part of a portfolio of not just one thing, but a portfolio of different, diversified investments that will be, valuable, as the world changes, because it definitely is changing, and I'm seeing that happen in our own backyard here. So just thought I'd share that with the group. Thank you.
Member Tejas, that is very welcome comments. I appreciate hearing about SFCC and their role in renewable energy in New Mexico. That's why it's important to have, differing perspectives and backgrounds on this council. So I very much appreciate those comments. Any further questions from council for Brookfield while we have them on the line, or for our staff, or for Townsend on this investment? So hearing no further questions, I'm going to Member Eidson for our motion.
This is Member Eidson. Based on the recommendations of the Council Investment Committee, Private Equity Advisor Townsend, SIC staff, and General Fiduciary Oversight of RBK, I move that the State Investment Council approve commitment of up to $75 million to Brookfield Infrastructure Fund for LP Renewable Sidecar, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
This is Harold. I'll second.
Okay, so we have a proper motion from Member Eidson, a second from Member Lavender. Any discussion on that motion? Hearing no discussion, we'll have Carrie call the roll on a vote for the Brookfield sidecar.
Commissioner Garcia Richard?
Yes.
Secretary Romero?
Yes.
Treasurer Eichenberg?
Yes.
Peter Frank?
Yes.
Linda Eidson?
Yes.
Harold Lavender?
Yes.
Lee Rawson?
No.
Tim Jennings,
No.
Mike Messina,
Yes.
and Nick Tejas.
Yes.
On a vote of 8-2, the motion passes.
Thank you, and thank you to the representatives from Brookfield for being here to answer our questions today. Thank you.
Thank you,
we're
Madam
gonna move
Chair.
on.
Thanks. Thank you very much.
Thank
Thank you.
Thank you.
We're going to move on to agenda item 3C to hear about capital market assumptions and our asset allocation review. That is going to be from Mr. Smith and I believe Marcia and Matthias.
Well, thanks, Madam Chair. And just a couple of opening comments on this section. Each year, our consultant RVK updates their long-term capital market assumptions. We generally bring that to you in April. This year, due to COVID and the volatility in the markets, we pushed that out here to this fall. But the presentation you'll see today should be familiar to those that have been on the council for a little while. RVK will run through how they arrive at those long-term assumptions and some of the detail behind them. And then we'll take you through each of the portfolios and how those new assumptions affect potential future rates of return from them. Just one or two comments on that part. You know, we're still with the growth funds, we're still hanging around that 7% return potential. So I don't think we need to review those targets. That was a little up in the air for us, over the past few months. But it looks like through this analysis, we're still able to forecast, in the neighborhood of that 7% for land grant and 6 3/4 for severance tax. I think as Investment Committee Chair Eitzen mentioned, with the new investments, new directed investments and the severance tax, we may need to review that number going forward. But we need to get our hands around, exactly what these new investments will mean in terms of potential return for that portfolio, and then maybe bring you some information or a study on that 6 3/4 for severance tax. The other thing is you'll note that income levels across all portfolios have fallen relative to last year, and Marcia Matthias will touch on that, I'm sure. So still a concern to maintain and build income in the portfolios through the asset allocation, and we'll talk about that in a little bit with the annual investment plan after we get through this material here. So with that, I'll ask for any questions we have just from a high level, and then we can pass over to Marcia Matthias to take you through the assumptions.
Actually, I think we're just going to go into their presentation and I'll take questions at the end.
Okay, thank you, Madam Chair and Vince, for the lead-in. Appreciate it as always. And good morning, everyone else on the line today. As mentioned, we do have quite a bit of material to cover. Probably won't cover every page, but happy to address comments and questions along the way. We'll try to highlight what we think is most germane to current market conditions and relevant to these discussions. I'll take the lead on capital market assumptions and the intergenerational equity piece, and then Marshall will walk you through the various asset allocation studies that we have for your review as well. Starting on page 151, this is just a high-level overview of this process. Vince already alluded to the fact that this is an annual process. Typically, we do it at year-end, trying to determine long-term forward-looking, and that's key, those two things, the forward-looking and very long-term in nature. They're not short-term calls on market movements, but really just trying to get a sense of what those long-range expectations ought to be through a fairly rigorous process. It essentially takes all year and then we start all over. Our return assumptions, just in summary form, utilize a return decomp or decomposition model. I'll explain that a little bit more later on, and ultimately looks at all the various return drivers such as income, anticipated growth, valuation levels, particularly relative to historical levels, inflation, and economic conditions. So there's a lot that factors into the return estimate, but really looking at volatility and correlation, which are the other two primary ingredients to the set of capital market assumptions, is also very important, and that's driven by a similarly comprehensive review of historical trends. We adjust for regime changes when we see them, as well as triangulation considerations, because again, it needs to make sense in the broader grouping of asset classes. This year has been very significant for a number of different reasons, and for us, a first, in that we actually decided after a lot of contemplation to reissue capital markets after the market dropped precipitously at the end of the first quarter. And as I said, we spent a lot of time thinking about that, but we did see really unprecedented fiscal and monetary policy measures that were coming out and that have continued to come out. And for that reason, we've updated those expectations given just the level of movement across all various parts in the market, including rates, the equity valuations that came out of that, and then inflation expectations. Talk a little bit more about inflation going forward. There's a number of push and pull dynamics there, which ultimately leads to just more uncertainty in terms of the directionality of future inflation. And we'll try to highlight the potential implications there as we get to those sections. For those that maybe haven't been through this process a number of times with us already, I will just note that these assumptions are typically index-based, so we're not trying to forecast any substantial outperformance or alpha from your investment managers. We're really just trying to model the market or the beta exposure within the portfolio. You'll also notice that we tend to make gradual changes, even though markets can move quite significantly, like we saw this year, equity markets dropping 30+% and recovering in fairly short order. Our assumptions don't move nearly as much. We want to avoid churning the portfolio and really sort of always chasing those potential returns. If we see persistent trends, we'll try to incorporate and capture those, but you're not going to see assumptions moving by 5% from one year to the next. On page 152, we talk about the accuracy and how one can define that. Ultimately, what we talk about when we say accuracy is the relative accuracy, essentially saying if you were to ordinal rank or from best to worst the various asset classes, is that order more or less accurate? And to the degree that it is, that's our goal. Then usually what we end up with are investment portfolios that perform really quite well across a range of potential economic conditions. Again, we don't know precisely how the market will unfold and what level of return it'll give us. We're just hopeful that we have a thoughtful and diversified portfolio that is able to participate on the upside and hopefully hold up in substantial down markets. But that's not to say that the absolute accuracy doesn't matter. By that we mean, does the portfolio return 6%, 5%, or 10%? We try to get that number as close as possible as well, because of course it informs the intergenerational equity. We'll talk about that in some detail, and as part of that, your sustainable spending policy as well. So it has implications. It's important, but the first step is really just getting the mix and the weightings of those asset classes as optimal as possible. On page 153, a couple high-level themes I've already discussed. Inflation. The inflation assumptions here has continued to come down through the end of last year and the first quarter. There is, of course, anticipated probability or likelihood that central banks will continue to struggle. They have for a number of years to meet their inflation targets of 2%. And there's continued downward pressure from energy prices. We've got global debt and some growth challenges, particularly for the near term. But again, over the long term, I was talking about the push-pull dynamics. Over the long term, there's quite a bit of catalyst for potential upside surprises, and I think this year more than ever, the certainty of which direction inflation will go and to what magnitude is probably as uncertain as it has been in quite some time, and so that gives us some pause in terms of making too many conclusions about that. And we do recognize that inflation is an important ingredient to a lot of the modeling. So for now, though, we think it'll probably stay muted, but we do anticipate that there's quite a bit of room for upward moves on the inflation front. On your valuation perspective, particularly for your equities, of course, those look a lot more attractive, although still elevated after we had the drawdown at the end of the first quarter. A lot of that has been gained back, and so these assumptions are as of the end of the first quarter. And while I think directionally still appropriate, we have to take that with a grain of salt, recognizing that this year's been so volatile. We'd have to update these numbers almost on a monthly basis to try and capture the types of volatility that we've seen. And then this month, as we talked about on the performance review, has given some of that back. But year to date, we're certainly in positive territory back for equities. So some of these numbers have already been reflected in the returns that you've seen. I think the probably bigger story there is fixed income. Yields have continued to trend down. They've been trending down for the past 30 plus years. It's been a great run. It's been the bull market essentially for fixed income for quite some time. But where we are now has really challenged what we've become accustomed to expect from fixed income, and we'll talk a little bit about that later. And so when you have the 10-year Treasury returning 4, 5, 6%, a 7% investment target isn't all that difficult to achieve. But at current levels, when we're lucky to get 1%, is very, very different. And then in some cases, flat or negative on a real basis. So it's become a lot more challenging to be portfolio allocators. But we're really trying to be thoughtful about where we see areas for potential and bring those to your attention. Although I would say you've been taking a fairly forward-looking approach to that for quite some time. 154 and page 155, I'll just cover very briefly and just point you to it in terms of our building block methodology. As I said, for pretty much all the asset classes where possible, we look at what are the sources of return for each of those various asset classes. We try to value and evaluate each of those components. Like on 154, you see yield, inflation, growth, which is comprised of GDP growth, but also profit margin growth, and then anticipated changes from valuation. So we look at all of those individually, try to get a sense for what that might be, and then put it back together. So it's a deconstruction and then combining of those individual components. Other asset classes, usually private market asset classes, where there's some form of liquidity premium that is expected or to be harnessed for the lack of liquidity, usually has a premium associated with that over the public counterpart. And that's something that we look at as well. Is that premium changing? Is it growing? Has it contracted over time? And it's not. We have to see some consistent trends there to make meaningful changes. And private equity has been one where, for some time, the premium has started to compress. It's still there, or at least it's expected to be there. These last 10 years have obviously been fantastic for public equities, which has lowered the premium. But overall, we do still think that there is pretty distinct advantages in being in the private market space. 157, this is a purely valuation-based chart, and it's the Shiller price-to-equity ratio, which is often quoted. And here what it looks like, or looks at, is essentially saying what is the predictive power of your purchasing price relative to future returns, and it just essentially says if you pay quite a bit for each unit of earnings, your forward returns are going to be lower, and reasonably high correlation on this chart, which just means that it tends to be relatively representative. And what we can see here is that even though the price to earning ratio has come down a little bit, we're still pretty far on that right-hand side of the chart, which means lower returns going forward. On this trend line where we are right now in terms of your PE ratio, this would indicate 5.4% out of U.S. stocks on a nominal basis, but then by the time you factor in inflation, you're looking more at 3.5, 3.4. So not great prospects for U.S. equities. And again, this just looks at valuations. There's more we look at than just that. But purely on a valuation basis, it's not a great picture. It actually gets worse on the next page, 158, when you look at it from a fixed income perspective. And there, yield is an even greater predictor than your PE ratio for equities. You can see the correlation is 93%, so very, very strong relationship. And you can see that we're actually off the charts here in terms of how low yields are. And all that to say that the nominal return, again, on a valuation basis, maybe somewhere around 2%, but net of inflation or on a real basis, it's essentially zero. So as I mentioned, the key attributes of fixed income that we tend to look for, which is income, downside protection, liquidity, little bit of on the deflation side, those things really aren't maybe as strong as they had been historically. So we should expect some challenges there, and I think that will be reflected in some of our asset allocation discussions as well. So not quite the hedge that I think it's been for us, and again, that is part of why we think it'll be challenging going forward on an allocation basis. Page 159 just provides a lot of the detail of the various components within each of these asset classes. I'll just make a couple high-level comments that overall, as it relates to equities, yield, growth, and valuation, generally appear more favorable outside of the U.S. That's been the case for quite some time, and that case hasn't weakened really any. So we do think at some point we're going to start seeing some better relative returns from the international space, and I think that's reflected here in these numbers. On the fixed income side, as I said, it's really been quite challenging as yields have just gone so low. They're well below historical averages. They're well below the 10-year average. And spreads, which is that middle column in the bottom, those have widened at the end of Q1, but spreads have really come back in quite a bit since the end of the first quarter. So a lot of that, you probably noticed it as you looked at some of the fixed income managers, the ones that tended to have more spread product in there or that were a little bit more in the plus sectors, really took a beating in the first quarter, but then rebounded quite sharply in the subsequent periods. So again, a lot of this has been fairly dynamic and volatile this year. We're not quite used to seeing it move all that much. On page 161, asset class yields. Again, I've touched on it for the traditional assets, and as Vince mentioned, for U.S. equity on that right-hand side, this is essentially year over year, 5 quarters since we're going all the way to 3/31, not the end of 2019. But a decrease primarily in the fixed income space. So getting yield out of your traditional fixed income is going to be challenged. Your equities are down, but very modestly so. And we did see some improvement though on some of your other asset classes, so non-core and real return. So that is that's perhaps the silver lining there. On page 162, just a brief note on our risk process. And every year we try to refine or at least improve some part of our process in one way or another. And it's a fairly lengthy list, but we only try to implement one or two things just to keep things smooth, I suppose. And this year we took a closer look at our risk approach and how we assess what the historical volatility and prospective volatility ought to be. In this case, we've expanded how we approach that and are looking at it now through a number of different lenses, recognizing that not every asset class is homogeneous in terms of the risk properties. Some of them have different distributions of risks. Others have challenges such as smooth or less frequent market values or valuations, particularly on the private side. And so for that reason, we do think we have a better process. It has resulted in a slight decrease in some of the risk numbers. That's not to say, and I think this is quite important, that we're now in a less risk environment. I think if anything, we're in a more uncertain environment, but it's primarily a byproduct of just an improvement in the process, and we think it better reflects the actual volatility risk that we ought to expect going forward. Okay. And if there's any questions, please feel free to jump in at any time.
Yeah, Matteo, just keep on going, and we'll take questions at the end.
Okay, perfect. I might turn you to page 166. This shows the expected compound returns ordered from highest to lowest across all the major asset classes and some of the subcategories, I suppose. But and what we've done is overlaid the 7% Land-Grant long-term return target with a orange horizontal line, and you can see now that there's actually quite a few asset classes, primarily on the risk front, that are anticipated to earn more than 7%, but quite a few that are below. At the very end, of course, now is your more or less traditional fixed income, where we're not anticipating much of any return, certainly on a real basis. And so I think that'll be challenging. The good news is that asset allocation allows us to combine multiple assets, and if they're complementary, we can actually get more return out of that combination than we would out of asset classes individually. But still, I think it'll be a challenge. You may recall that last year when we looked at this, there was maybe just one or two asset classes that were up to that 7% return target. So the drawdown has helped, but again, I would just caution that some of that has already been regained, and we'll need to take another cut, another measure once we have year-end numbers and see what that informs us going forward. On the next page, 167, and we talked about that as well, income being important, particularly as uncertainty increases. And here on this chart, what we've illustrated is how much yield or what the current yield is for the various asset classes in gray, and then the green or red bars implies what type of appreciation or depreciation is expected to get to our total return expectation. And so, of course, if you have more gray, then you're less dependent on appreciation for your total return. And when uncertainty is high, that tends to be pretty attractive quality or characteristic. Although some of those are also subject to some losses, or at least anticipated losses. On 168, really the way I would summarize this page is that we try to forecast these assumptions, and it's challenging. No one knows exactly how things are going to shape out, but we try to be fairly realistic and conservative in those numbers. We're not trying to sell anything. We want you to be prepared for challenges that lie ahead. So we don't sugarcoat it, and we don't think hope is a strategy. So while sometimes it's difficult to see numbers that are lower than we'd like them to be, hopefully they do provide you with some sense of what we expect, and do recognize that in some cases they require tough choices. All the pages that follow here are diving a little deeper on each of the underlying components. On page 169, you have U.S. inflation and cash. Inflation is a component of most asset classes in some form. As I said, the inflation assumption has come down, but I think it's very important to note that the uncertainty around which direction inflation will go is quite high. That gives us a little bit of concern, certainly over the intermediate and long term. I think for the short term, we can feel relatively confident that it's not going to give us too many surprises. But again, a lot of the modeling that we do, certainly on the intergenerational equity front, is 25 years, and that's a lot longer than the next couple years. But I would say, looking at break-even inflation rates, which is implied market returns or market expectations, are very low. You can see those over different time periods at that bottom left table in green font, and that's just really the difference in yield between a treasury and a TIPS for the same maturity. And again, it's well below 2%. It's dropped even further just from the end of 2019 through that first quarter, and the Fed's still targeting somewhere around 2%, although it's probably given itself more flexibility in some of the more recent remarks. You've got demographics and lackluster productivity gains that may keep some pressures in check. We'll see how that materializes. That does tend to come in waves. We have a lot of monetary policy, certainly to the magnitude now that we really haven't seen before. So, like I said, that may create some upside surprise. But we'll just have to keep an eye on it. For now, I think we need to recognize that inflation can move, can be volatile, and we can have surprises in both directions there. Public equities on page 170. There again, they improved, of course, as they should. When you have a drawdown, that gives you more room on the upside. But as I mentioned, we've had a pretty good period since then, and in this month we've had about a 5%, maybe a little more now with yesterday's sell-off in the S&P 500. But year to date, we're still in the positive by a few percent. So again, I think these numbers are still generally representative of I think where we are, where we think markets are going, but maybe just moderate your expectations given what has happened over the last 6 months since these numbers were originally struck. On the international front, on 171. Same thing. We had some nice improvement in returns, as I mentioned. On a relative basis, we still think international has more forward momentum, but it's taken a while to materialize. Private equity on 172. We look at that starting with the public equity proxy, and then look at what the premium is over time. You'll notice that premium, that's the blue line, a rolling 10-year average, that has come down. Probably, again, not surprising given that it's been very difficult to outperform the publicly traded equities since the great financial crisis a little over 10 years ago now, and so that's one of the reasons. But there's other reasons why that premium has come down. Historically, we've seen it a little bit closer to 3, a little bit even over 3, but we've brought that down to 2.75 in the most recent time period. But still, again, still an expectation of better returns relative to public counterparts over the long term. On 173, this is your traditional U.S. aggregate fixed income, and as I said, yields determine a good portion of forward returns. And given what has happened to yields, that number has come down and continued to come down. Starting on page 174, we look at some of the plus sectors. So they fall under the fixed income umbrella, but really they're not capital preservation. They're more like your equities, high yield, bank loans, emerging market debt. They're return seekers. They're not your safety net, and they'll perform a lot more like your equities than they will your traditional fixed income like treasuries and things of that nature. So in this case, actually, we had a positive move in expectations because of what happened to yields. Yields moved up quite a bit, and as I mentioned, spreads really blew out at the end of the first quarter, but some of that has already normalized since then. And the same is true on emerging markets, particularly on a hard currency basis. 176, low duration and long duration, just for your reference there. You've got some exposure to low duration. Again, we saw the Fed cutting rates and yields in that particular space have decreased pretty materially, and are not expecting a whole lot out of the fixed income asset class. Could rates go lower? They could, but there's probably some floor in there. And I think we're a ways off of negative rates. We might get there at some point. There's probably other tools that we deploy before then. And short of a pretty steep yield curve, I just don't see how we're going to get attractive returns out of this asset class. Starting on page 177, we get into some of the more customized approaches that we take for you, where implementation differs from the standard or the broad market. Within your core fixed income, so this is truly the capital preservation or the safety net allocation, also the source of liquidity. You do have a different mix a bit. You can see the weightings at the top, and you can see the bar graph in the middle of the page that is your exposures relative to that broad market. So green is your portfolio. The blue bars represent the aggregate index. And so you can see some differences, but by the time you put it all together, when you look at the various portfolio characteristics on the left-hand side, duration, maturity, credit quality, you're really pretty close. And so as we look at this, we think you're sufficiently close to that. You have some structural tilts in there, but by and large, we think that the standard assumption is representative. And that's been the case for a number of years. On page 178, same thing, but for your non-core fixed income structure. And again, that serves a different purpose. For this particular asset class, we are creating a custom blend of some of the underlying exposures or target exposures, if you will. And in this case, by the time you roll it all up, you can see our expectations there relative to the core allocation. We are expecting about 160 basis points, a little more than 1.5% of compound return premium, but also a bit more risk, 2.5% more risk than your traditional fixed income. So it serves the purpose, but it is a distinct purpose within the portfolio. Starting on page 179, we get into the I would say private market asset classes, starting with core and non-core real estate. Overall, real estate expectations have decreased a little bit, just given our lower expectations for inflation. So you can see we've taken 25 basis points off of the return expectation. Although I would say that valuations look elevated, I suppose, on a more absolute basis relative to treasuries, which in some cases that comparison is made. They're actually quite attractive as those fixed income yields have decreased even further. So I think there's still quite a bit to like about this space. And currently we've got a bit of an overweight to core, but I think as the fallout really comes to be fully known, there'll be some opportunities out of that within the non-core real estate space, and I think you'll see some interesting opportunities there. You have a 55-45% target on page 180. We highlight that, and so we use your custom weighting, but our standard assumptions for the two sub asset classes, core and non-core real estate. Within your real return allocation, you have a much more thoughtful implementation, I think, than just your traditional tips, commodities, and REITs, which have a whole host of their own problems. That's on page 182. It's been one that's continued to evolve a little bit, comprised of both financial and real assets, with 20% in financial assets and 80% in real assets. It's an asset class that I think you'll particularly on the real asset side of things, you'll move through the J curve and start to see more benefits. But it's really an asset class that will shine when we see rates increasing and when we start to see more inflation. So neither of those two has really happened, and you're getting some nice income in the meantime. But I think if either or both of those two things do start to materialize, I think you'll be real glad to have an allocation to this bucket. On page 183, this is new this year, and I think it's been discussed for a number of years. But I think it's gotten to the point where it made sense to try and piece out the in-state private equity portfolio within the severance tax. We've had some conversations with the staff, with Dave and Chris, and try to get a handle on what we might reasonably expect out of this program. It's a program that's still in flux. It's changing. It's been changing. You can see the current composition is fairly concentrated, and a long ways off of the long-term desired allocation. I think that balanced with the dual mandate, really, of this program, not just to generate attractive returns, but also to create jobs and be a meaningful contribution to the local economy, I think has been really the primary reason why we're trying to get a better handle on those returns. And so we took a fairly conservative approach. I think these members are really an educated guess, I will say, and try to reflect what we do know. As the current composition becomes more aligned with the long-term desired composition, I think we can try to incorporate that within the assumption with the current concentration, and I think very wide range of potential outcomes. on the up, but also on the downside, has led to these numbers that we've considered here. And so you see a return assumption on an arithmetic basis of 3%, which is pretty close to what the historical number has been, and the standard deviation, which is based on the national program of 22% plus a 5% premium over that, and so you can see those figures at the bottom of this page. As we learn more and as there's more information available, we'll hopefully be able to refine those numbers. But I think for the time being, with those folks that were able to lend their insight, that's the best that we could collectively come up with. So maybe I'll pause there before we transition into the intergenerational equity analysis, see if there's any questions or comments before we move into that section.
Thank you, Matthias. And I just want to say from the entire council before we go to council questions, we know that you are dealing with a lot right now with some family issues and health crisis. So we just want you to know that we are sending you good thoughts, and if there's anything that we can do to support you, please let us know. I know you spent a lot of time on this product, and so you wanted to be here to present it in depth and take questions. But we know that you also are undergoing a lot of other pressures in your personal life. So just thank you for being here today, and we're sending you good thoughts.
Thank you. I appreciate that very much.
With that, we're going to move to council questions on the first part of our capital market assumption presentation from RVK before we move into the intergenerational equity portion of the presentation. Are there any questions from council thus far?
This is Linda. I was just wondering if we're going to get any guidance on the SBIC has given us guidance on return expectations there, saying none. Are we going to get any type of return expectations for the Small Business Recovery Act money managed by the MFA?
Linda, is that question addressed to me?
Whether it's for you or for the State Investment Office, as that has become a larger part of the severance tax, at least for the next 6 years or so, it'd be nice to know if we have, as we build that into our return over the next up to 10 years, that's 6 years of it, if we have some return expectations to build into that so that we can establish a target return for the part that we're managing from the SIC as well as for the total fund.
Linda, could we ask either Brent or Vince to respond to that? I don't know that the the New Mexico Finance Authority is going to be providing that information. Brent, in your discussions with Marquita, is that part of what they are responsible to provide us?
Steve, I've had some brief discussions with her. I don't think they will be providing assumptions. I know internally Vince has some views on that about potentially keeping that because we can't control it kind of out of the return calculation, but that's probably still open to more discussion. Steve, it's Vince here. Yeah, they haven't provided any guidance, and I agree with Brent. I don't think we'll get any from them. The problem we have, and what I'm very concerned about, is we just don't have right now. We just don't have a basis for making a return, risk, and correlation assumption for those assets. Correlation assumption versus the rest of the portfolio, and a return or risk on those assets. We just don't have much of a basis for that, any basis that I can find. And without a proper basis and being able to forecast those returns, it's difficult for us, impossible for us to include it in the mix. We have to have those three numbers: an assumed return or an expected return, an expected level of volatility, annualized, and a correlation to each of the other assets that we own. And we just don't have a basis to do that right now. So we're looking into it. We're trying. And Brent's right. I've got a couple of ideas that I'm running down. But for right now, we're sort of dead in the water in terms of being able to incorporate that in the asset allocation and give you a responsible number, for severance tax, including those assets.
Linda, I think that's about all we can provide as of right now.
I understand your dilemma. How frequently will they be reporting to the SIC on the valuation of the assets under their management?
I don't know that they will be reporting on the valuation of their assets. Brent, is that part of our agreement with them?
Madam Chair and Linda and Steve, we've had discussions. We're going to be at least getting in financial statements. We haven't gotten in the initial ones yet, but we'll be getting in financial statements from them on a monthly basis, probably lagged a month, but we'll be getting them in nonetheless. I would anticipate it's more or less going to be, whatever loan amount, whether or not they have an allowance for doubtful accounts in there. I don't know. I would think they probably would. So we're still waiting for that initial reporting. And once we get that, I'll make that available to everyone.
Thank you so much.
Additional questions from council before we move on? All right, Matthias, if you could continue, I believe we're on page 186. 185.
Perfect, thank you. And I'll try to pick up the pace a little bit. I'll look to you to let me know where you might want to dig a little deeper. On page 186, just again for those that are newer to the council, intergenerational equity is a concept that we've been looking at quite closely for a number of years, and what it tries to do is strike a balance between present and future generations of beneficiaries to make sure we have a good balance. There's three components that will factor into that. We have those listed at the bottom of page 186. Essentially, your contributions or your inflows, your distribution policy, and then the investment return that you earn net of inflation. And those together should work in harmony to balance, as I said, the competing needs between today, but also making sure you're not overspending for the future. We've defined that on page 187, where ultimately we've defined the objective as not just preserving the purchasing power or the economic value of the fund, but also accounting for 0.5% of real growth. And that's for a number of different reasons. It reflects population growth, and again, that is somewhat episodic, but also the depleting nature of the funding source of the contributions that are finite generally, or believed to be finite. And so having a bit of a growth component in there has made some sense. Ultimately, the target is 50%. That is the score, if you will, that we try to get you to as close as possible. And over time, as some of the contributions, the return expectations, or the distributions, as those change, the value can change. It is relatively, I would say, volatile from one year to the other, just because, at least in the most recent years, we've seen volatility on two of the three components. We've seen capital markets, or your investment return, moving quite materially, and we've seen changes to contributions as well, and so those have their own unique impact on the forward-looking measures. Currently, we go to page 188. This lists all of the assumptions that factor into this. We have a score of 79. That's that's higher than it's been historically. Just a year ago, in 2019, it was 58.7. So just in a single year, it moved up almost 20 points. And that's as much as we've ever seen, but you really almost had a perfect storm of all things that improved that number happening. I think the flip side to that is just as quickly as those things can happen, those can go the other way. And so I would just caution you to be mindful of that. Certainly beats being below 50%, being above 50%, because you're able to make adjustments that perhaps are not as painful as the alternative. But just recognize that ultimately the way that we tend to look at this is your long run over a 25-year period. What trajectory are you on? And if you find yourself on the same trajectory, either overshooting or undershooting for a number of years, then you course correct to make sure that you get back on track. But you don't want to find yourself in a position where one year you're changing one lever and then the next year you're changing it back the other direction. But if you're seeing persistent trends, then certainly they need addressing. And some of that is true for severance tax, for example, where you have relatively persistently low inflows, and that's been a relatively big impediment to that fund being able to get to the 50% target. We can talk about land grant in more detail there, but I think those are the main items that I would point out. I will say that we have an even more nuanced approach here in terms of lower inflation expectations over the near term. That also helps. We have some lower expectations for near-term investment returns, and a lot of that ties into the investment plan that Vince has presented a number of times. So I think the story is good, and obviously we'll continue to take a look at that. And to the degree that you remain above 50% and quite above 50% for extended period of time, you can pull one of the three levers that we looked at the very beginning here of this presentation to course correct. But again, I think it's important to recognize how sensitive the model can be. That sensitivity is shown on page 189. At the top of that page, we've listed some of the factors that contributed to the big increase in the value this year. And as I said, they can go the other way just as quickly, really. We hope they don't, but they could. And so what we've done at the bottom of this page in the box is looked at a scenario analysis, essentially, to say what would happen to that 79% score if various assumptions that are factoring in here either move up or down. And you can see that if we have inflation surprise that is quite a bit higher than what we've modeled here, then that could bring the number from 79 down to 53.6. So it doesn't take much, and that's just one component. If you have more of a multitude of factors influencing this, like higher inflation and perhaps lower contributions, because we're in a period of sustained low contribution, low prices. We've talked about the rig count and other things that we don't have a full appreciation yet on what it means for the next number of years in terms of contributions. That can also have an influence. So there's a great deal of uncertainty, but for right now, I think the score is encouraging. But the uncertainty is what gives us a little bit of pause. The subsequent pages look at that also for your distributions, and Steve in his report always gives you a good sense of that. But we do anticipate that the distributions will continue to grow on a real basis as well, and so we think that's quite good. On page 192, just one last scenario analysis for land grants. There, what we've done is said, okay, everything stays the same, but we expect the contributions to be half of the baseline, half of what we're actually expecting right now, what would that do to the score? And it drops all the way down to 51.9. So pretty much right on that 50% goal. And so again, that gives you a sense of how things can move, and taking that into account for future reference. On page 193, it's the same thing. I won't cover it in quite the same detail for severance tax. There you can see the score is 41.2, so it's below 50%. It's been below 50% for quite some time, and as I said, that is primarily due to the relatively low inflows relative to the fund size, as well as the lower expectation of some of the in-state programs. Return expectations that have a small factor in here as well. So the subsequent pages look at the same information for tobacco and for water. They're on opposite ends of the spectrum. Really, intergenerational equity there has never been a primary focus, but to the degree that it's interesting or noteworthy for you, tobacco looks very good. It's very high, and that's primarily because it's got a good asset allocation with no flows, because there's no distributions and no regular inflows. So for that reason, it's just growing at the return that it's growing, and it's above inflation. So it's quite high. Water on the other end, and that starts on 198. That has a fixed distribution of $4 million per year, and really pays no attention to what the fund value is, with no inflows. And so when you look at that $4 million distribution, that represents almost a 9% distribution rate, which is of course very, very high. There's no fund that can reliably and sustainably spend 9%. We know that, and so for that reason, the score is very, very low, 6.6. In fact, on page 199, you can see that if this fund stays on the same trajectory, it's actually anticipated to deplete the assets in full in the next decade or two. Here, this model is predicting 15 to 16 years out. So it either needs a lower distribution, a percentage-based distribution that would get smaller and smaller over time, or would need some consistent inflows in order to make that fund sustainable. So I know I've taken up a lot of time. I do apologize for that, and appreciate you allowing me to go through that. At this point, I'll just pause, see if there's comments or questions before Marcia walks us through the asset allocation work.
Any questions on the intergenerational equity portion of the report from council? So I do have just a couple of comments and observations, digging in more in depth to the slide 189, page 189 of diligent. And that sort of middle box there that shows the increased distribution to 6%, taking the equity ratio to 67%. I think you spoke about the levers that can be pulled, Matthias, and I think there's one lever in particular that the legislature has been itching to pull. I don't think it's any secret, to increase distributions for early childhood education investment. And I think very often when we talk about intergenerational equity, we focus to a large extent on future generations, almost at the sacrifice of current generations. I don't think we do enough, we don't give enough emphasis on current generations, and seeing this ratio so high and trending so high with that lower distribution amount, the 5% distribution amount that we have set in the Constitution, that concerns me. Seeing that 79% tells me that that current generations are sort of being cheated at the expense of what we're have around for future generations. And so if you could talk a little bit about, that middle box that shows the increased distribution to 6% and still having that high ratio, and whether or not an increased distribution could maybe be predicated on a ratio amount, and if we could look at increased distribution from that perspective, to increase them as long as they don't dip below 50%.
Yeah, no, sure. I'd be happy to. And a couple thoughts that come to mind there. I think first, maybe just at the highest level, before I talk about this box in particular, I think you certainly could consider changing the distribution rate. I think the one item there that I would note is that, of course, the contributions play a big part into that, and to the degree that those change and change for a prolonged period of time, that can have a meaningful impact. I think the other aspect that makes the distribution rate, and I would say the levers are not created equal, and you're exactly right. You have three levers to pull. The contribution lever we really can't pull because it's outside of the purview of anybody on this phone. The two levers we do have at our disposal is exactly right, the distribution rate, which is a lot more difficult to change than the last one, which is the investment return. We know we can't, if you were to pull that one, for example, you could reduce the risk and say we don't need to earn as much, we don't need to take on as much risk, and that would lower that ratio. That's of course not as desirable as changing the rate. I think the consideration just to be mindful of is that when you increase it, it's very, very difficult to ever decrease it down the road because folks become accustomed to a certain level. Now, that's not to say you shouldn't do it. If it's persistently high, I would think it's worth recognizing that that is probably the stickiest lever, if I can use that term. And we have that conversation with lots of the other sovereign wealth funds, sort of saying, you're welcome to pull that, just recognize it's much more difficult to change. Usually there's there is either constitutional amendments or the legislature needs to get involved to change that. That's not something that the SIC or the council can easily change on their own, much like the asset allocation. So it's a much stickier change, and if contributions, for example, were to be very low for the next decade, or investment returns fall materially short of expectations, or inflation materializes differently than this model predicts, then that could potentially put the intergenerational equity at some risk. So, I think legging into those types of changes can make a good deal of sense, particularly if you're seeing persistent trends. But as I mentioned, this model changed 20 points. It's 79 this year, but it was 58 last year. So that's as big of change as we've ever seen it. But the three bullets that I have at the top of page 189 are the reasons for that. And essentially everything that changed for the better. I'd like to think that continues into perpetuity, but I want to be cautious of that. This table also assumes that it's sort of an independent variable. It assumes that you're only changing that particular item, everything else stays the same. So you're absolutely right. 6% would be sustainable in this model if the returns materialize how we've predicted over the next 25 years, that inflation remains quite low, and that contributions continue to come in at pretty reasonable levels. So if all those things materialize, and I think a 6% is a no-brainer, I'm just want to be cautious that there are a number of things that can go the other way. And let's say you do have an inflation surprise, or you do have contributions, or maybe a combination of an inflation surprise and lower contributions, all of a sudden that 6% might not be at 67.2, that might be at 50 or even below 50. So I think you're absolutely right to consider all the levers. I just want to make sure folks understand how much things can change and how quickly they can change, and if they're comfortable, then that is certainly an option that you could pursue.
I guess my question was more, the proponents of this increased distribution have tried to put in different mechanisms, like a floor amount. If the inflows into the land grant permanent fund go below a certain amount, the increased distribution will revert back to 5. I'm just wondering if putting in something along the lines of watching that IE ratio, and if it starts to dip below a certain amount, we revert back to the previous contribution. That was my question. Is just kind of adding that additional component into a proposal for an increased contribution. What was the sort of the efficacy of that? But we can move on.
Madam Chairman, this is Jennings.
Member Jennings.
Yeah, I don't know that I would really say that somebody's been cheated from this, because number one, we have to remember that there have been many years this fund didn't even grow. I mean, one year it grew $87. That's a real whoopee-doo. And so there's not a lot of new income always coming in the fund unless there's really a disastrous event. And about this current generations and the ones that are here, I don't think we should forget that the income from these funds are taken out. And when I started in the legislature, we had 5-year severance tax bonds. They were paid off in 5 years. Now they're stretched out to 20. And, virtually the funds from, these bonds, the funds from these funds have been used to build basically every museum, every building at the university. And now used to have local money going to schools, and now it's almost all comes from the state. So, I don't think you can say they've been done. At some point in time, for land grant and permanent funds and all this stuff, some of these, these were for all generations to use and not just one. And so sometimes we have to look at that. And I think that if you need to change some of if you're upset with school funding on early childhood, you want more early childhood money, maybe you want to change the funding formula for early childhood. Change the funding formula for the schools. And that's some things to look at. But, I don't think they've been shortchanged at all in anything. I don't think the fund is continued to grow as rapidly as it should, because in a number of respects, going from 5 years to 20 years on bonds on paying it back is a lot. And, it's just, I don't think anybody has been shortchanged. If anything, it's that we haven't let the fund grow as much as it should have grown. And there ought to be some annual interest rates that the fund should at least be guaranteed to grow. And plus new income that comes into it. And we don't get that much. We just had an anomaly where the price of oil went through the roof, and we did real well one time with uranium and stuff. So, there's a few anomalies that come along that send things through the roof, and everybody wants to get spend happy, but we need to look at it. And, the one time we did get into the fund and went to 5.5%, 90% of the legislators down there and the people in the state can't tell you what we did with the money when we increased to 5.5%, or whatever it was under Richardson. They can't tell you what we did with it. So,
I don't want to get into a debate here, Member Jennings, but there is good data that shows an inverse relationship between the well-being of a state's children and education system and the size of their fund. So the larger funds actually have a lower well-being metric, and that's a inverse relationship that is shown in multiple areas. So that's what I'm arguing right now. But I don't think we need to get into a debate about the contributions. I just wanted to ask my question, and I'm going to move on at this time.
Okay.
Madam Chair, this is Member Eisen.
Member Eisen.
I believe that the formula that RVK used as far as contributions overweights recent contributions. And this computation ended as of March, when, as you know, we were still getting the really, really high contributions from the land office. So it is overweighting the last 12 months or so of contributions when they're saying what the contributions are going to be for the next 10 to 20 years. So I suspect that the land office is probably not forecasting contributions from the land office to continue at that trajectory for the next 10 to 20 years. So it's more likely than not that as we look at that chart, we're going to have an impact of down in the assumption for the annual contribution. So I suspect that as you're looking at what contributions are going to come from oil and gas on state and federal lands between the severance and the land grant, that those numbers are probably not going to increase at the level they have in 2019 through March of 2020.
I appreciate the reminder, Member Eisen, but it's been stated on this call that even last year, the IE ratio was above 50%. I mean, I'm looking at that ratio, and we don't want it to dip below 50 for sure, but I don't think we pay enough attention when it's above 50. That's all I'm saying. Further questions from council? All right, I believe Marcia is going to take us into the asset allocation review.
Yes, Madam Chair, thank you, and council members, thank you. I'm going to keep this portion pretty high level. I think we've gone over an hour here, so we want to be sensitive. So what we're going to do in this section is talk about asset allocation and the year-over-year changes. Coming out of this discussion, there's a couple things that we want to point out. One in the land grant, but there's only one action item, and that's a discussion of the asset allocation for early childhood education funds. So with that in mind, and the great background that Matthias gave us, using those capital market assumptions, we model asset allocation. And I always make this reminder that asset allocation and mean variance optimization, which is behind this modeling, is a tool. It's a great tool. It's a quantitative tool. We rely on it, but you also have to have judgment. And there's qualitative factors that can play in as well. But again, the goal here for the land grant on page 202, this is, again, showing year-over-year changes. We show on this page, there is no allocation change on this page. We're just simply showing the effect of the change in the assumptions on the return and risk of this portfolio. So looking at land grant, you can see in blue the target return for land grant and using the 2019 assumptions, and then to the left with the green is using the 2020, we call it 2020 Q1 assumptions. I'm just going to refer to 2020, and the reason we show Q1 is, as Matthias mentioned, we did our capital markets, and then because of the drawdown in markets, we did something we'd never done before and relooked at capital market assumptions. So using those revised assumptions, what happened between 2019 and 2020, those changes, the effect on the portfolio we have highlighted in the red box. When we look at expected compound return, you picked up 30 basis points of return due to the assumption changes. Volatility actually decreased, and Matthias reviewed the volatility. RVK is not saying that we believe volatility in the markets have gone down. it was a methodology change, which ended showing a decrease in the expected standard deviation. So again, moving from 2019 assumptions to the 2020, there was a pickup of 30 basis points, but that still brings you short of the 7%. So in geometric terms or compound returns, the expected return is 6.7, coming from 6.4, but still under the 7% goal. And I'll show a couple other pages on the land grants as well. If you go to page 2003, this is the actual modeling. We have the model kick out 10 portfolios. On the right-hand side, again, we're showing your long-term target. We did something here when we modeled this because we all know that, and Matthias has spoken to it, and so has Vince, that yields came down and the cost of holding fixed income has increased. So we did something on this page. Matthias talked about the inputs, capital market inputs, which is expected return, expected standard deviation, and correlation. There's another input, and if you look to the left, you'll see mins and max. We constrain the model in this review to hold your core fixed income at 7%. So you can see a min of 7, a max of 7, and we ask the model to run. Again, your target is at 10. So we're saying, okay, what would happen if core fixed income was decreased by 3%? And we highlighted portfolios 5, 6, and 7. Now, again, looking over at land grant under the green, and we spoke to it a moment ago, that your compound return expectation using the 2020 assumptions is 6.7% return. If you look at portfolios 5, 6, and 7 that have the lower allocation to core fixed income, the compound returns are very close, and in the portfolios 6 and 7 better. So the story here is that you can reduce your fixed income and still have very close to the standard deviation or volatility of your current long-term target, and will be something that we'll discuss more, I believe, in the coming year when we have our new capital market assumptions, and we'll bring this up again. But those 3 portfolios, you can get in 6 and 7 a bit higher expected compound return with just a slight bit more volatility to the portfolio. That puts you in a good position and reduces the concern with where fixed income is today. Just as a comparison, looking at the bottom left-hand side, you can see the 2019 assumptions there again reviewed, and again coming up in expected return. On page 2004, you'll hear us talk about geometric and compound return. We're really focusing on that more because that really takes it's really your risk-adjusted expectations. And we think that's more valuable because volatility doesn't matter. So we're looking at the efficient frontiers. The top efficient frontier is looking at the arithmetic. The bottom efficient frontier is taking into account the volatility, and we call that the geometric. I think it really is that risk-adjusted frontier on the bottom that's dotted. And when you look at the efficient frontier in geometric terms, it's much flatter. So if you look at that and you look at the different portfolios and where you stand, you fall on both efficient frontiers, but on a geometric basis and how it flattens out, that tells you it doesn't really pay to go too far out on the risk side, the right-hand side, because you're not rewarded as much the further you go out. Page 205 is looking at, we talk about the Monte Carlo analysis, but looking at the 50th percentile, the median outcome, running all this analysis, and we look at a 1 year, 1.5 year period, 3, 5, and 10. So just what this tells you on the 1 year, that currently with your target. Kind of your worst case scenario is a 29.8 loss in a 1 year period. Best case, 34.9 on the positive side. Obviously, as you invest longer term, you can see that's reduced going down to the 10-year, where you could worst case experience a negative return of 1.1 over that 10-year period, and that's 13.2 on the best case. But the median outcomes is at 6.8 again, which is better than it was with the assumptions from last year. Now, looking at page 206, this is a probability, taking that Monte Carlo analysis and taking the probability, and in this case, let's just look at the 10-year, and we've highlighted 7%, so taking your target return of 7%, what's the probability that you will get that? And looking at your current target, you're just below that 50%. You're at 48, and looking at the portfolios 5, 6, and 7 that we highlighted that have reduced allocation to fixed income, that stays very close to where you currently stand today. Any questions or comments about the land grant?
Questions from council?
So next we'll go to the severance tax. I'm sorry?
You can move on to the severance tax, yep.
Okay, great. On page 208, this is looking at that year-over-year changes. Again, the blue, above the blue is the 2019, and then the green is the 2020, reflecting no change in target allocation. And what you'll see here actually is, unlike the land grant, we show a 20 basis point haircut in the compound return. Well, why is that? Well, think back to when Matthias was reviewing the capital market assumptions, and we had done something this year that we hadn't done in the past, and we looked at the in-state private equity in a different manner. We're modeling it differently than we do the national program because it is very different. It's for the reasons Matthias went through, more concentrated, hasn't given a real return yet. So the assumptions of decreasing the return expectation for the in-state and also increasing the volatility for the in-state private equity, you can show that you actually took a haircut here by 20 basis points from going from 2019 to 2020. Just pointing out on the next page, which is 2009, and looking at the full modeling for severance, how we reflected the in-state program. We gave it a minimum of 9 and a maximum of 9, so it's 9% in in-state. We didn't let the model not take it because it probably wouldn't have taken it, so we forced the model to keep that 9% in there, and again resulted in the numbers in that decrease in expected return. 210 again shows the efficient frontiers both in arithmetic and geometric, and again that risk-adjusted efficient frontier, same story as land grant, flatter, so it doesn't pay to go too far out on risk. You're not being rewarded. Let's go to 212 and look at the Monte Carlo analysis on probability of achieving that 6.75, and still pretty close to 50 for the green, your current target for the 10-year period, but again below 50, which our goal is to get a probability of 50% or close to that. Next is early childhood, if we're ready to move on. This, we're not doing the euro.
Yeah, if you could just finish up all of the funds, and then we'll take questions at the end, Marcia.
I'm sorry. We'll finish up all of them and come back to early childhood, or should I go ahead?
Nope. Go ahead, and then we'll take questions at the end.
Okay. So early childhood, there's no year-over-year cover page, and there's, my understanding, still limited guidance on how to invest this portfolio. So we ran it more conservatively, not knowing at the time that we ran it, it should be a growth portfolio or not. I will mention that we ran it similar to tax stabilization in the rural libraries, and that is the green early childhood education potential 1, which again is in no exposure to equity, exposure to low duration fixed income and core fixed income with some non-core fixed income exposure, which is more private, and then you also have real estate, allows it to go into real estate as well. So the potential 1 again is similar to tax stabilization, rural library. The result of that portfolio using the 2020 expectation is to have a compound return of 3.6. We also modeled a portfolio which is potential 2, and in this case we said we only want public assets, so it's 60% in low duration and 40% in core fixed income, and as you would expect, the expected compound return is quite a bit less at 2.1. So these are the portfolios that we discussed. You can see the modeling, but we didn't allow the model to put anything in private or public equities. So low return expectation. And you can see that on page 215 where the efficient frontiers, because it is a less volatile portfolio, that the risk-adjusted geometric efficient frontier is much closer to the arithmetic. You can also see that the potential 1 is looking in a better position because of the diversification and the yield expectation or higher return expectation that you get by diversifying into non-core fixed income and to a certain extent real estate. So potential 1 looks better from a return standpoint than potential 2. And without having a return target on page 217, that we couldn't really do we show you different target returns and probabilities, but there is no stated one at this point. So I don't know. It's modeled to be a very conservative portfolio until further guidance is received. Vince, do you want to say anything or come back to that? Or
well, just a reminder that we do have a vote on the asset allocation for this fund later in the agenda. So, I don't know if you want to say the remarks for that item.
So we'll go quickly on the following ones. On 219, we look at tobacco settlement, no change in allocation there, but the year-over-year change because of the changes to expected volatility and expected return over the years resulted in this case of having a compound return that's very similar. You'll notice that volatility went down ever so slightly. That was more methodology, as Matthias reviewed. This portfolio has exposure to public equity, a small allocation to public equity, both U.S. and non-U.S., no private equity exposure, and low core fixed income exposure in the portfolio. So a return expectation, again, of 6.2, which is similar to what we saw last year. So no pickup in return, but a slight decrease in volatility. full modeling on the following page. And looking at page 223, if the target return is 7%, because there's less growth exposure in the tobacco portfolio, you can see it falls further below that 50% probability of achieving a 7% return. Water. Matthias went also through the water fund and the intergenerational equity, but showing on 225, looking at the year-over-year changes, this also is more conservatively positioned on a public equity side, but different than the tobacco. This does have private equity exposure, so no change to allocation, but there was a pickup in return of 30 basis points because of the return expectations, and also a decrease in volatility slightly because of the change in methodology. I'll take you on this one because Matthias spoke to it when he did the intergenerational equity, but if you go to page 229, back into what the flat payout is, we put it as a target of 11%, and you can see the probability of achieving that is quite low. So this fund is, as Matthias pointed out, is going to go to zero somewhere between 10 and 20 years. So the next two funds, tax stabilization and the rural libraries, are similar to what are the same allocations that we showed for the childhood education on 231. This allocation is quite conservative. No changes here. Again, no equity exposure. There's core and low duration fixed income exposure, and then non-core fixed income and real estate for that extra income. You can see from moving from the 2019 assumptions to the 2020, there was a significant drop, 120 basis point drop in return expectations, and volatility because of methodology change decreased slightly. And to do a probability of meeting the expectation, I think there is no guidance on what the return expectation should be. So we provided on page 235 a different target return expectations, just to give you a sense on page 235. And then lastly, on 237, rural libraries telling the exact same story as tax stabilization. Again, a drop in expected return due to the assumptions changes, and no stated return target for rural libraries. So that was a review of asset allocation, and I think the only action item is to go back to the early childhood.
Right. So let's see if there are questions at this time on that allocation.
This is Tim. I'm going to have to leave. I've got to take my son to the doctor. All right.
All right.
Sorry.
Jennings,
thank you.
Okay. Any other questions on this item? All right. We're going to.
This is Member Eisen.
Yes.
I just wanted to emphasize that the asset allocation for the early childhood education is something that we as the SIC are assuming to be, we have to invest it. We can't just leave it in cash. So what are we to do since we don't have any guidance on how we want to invest it? Do we want it for growth? Do we want it for preservation? Do we want it for yield? We don't know. So we are presuming that a conservative allocation is appropriate. So I just want to let everybody know that that is an action that we are taking of our own volition rather than from guidance from a client.
And Member Eisen, who is that question directed towards?
SIC members that we are voting on this allocation without direction from a client, because we know we have to invest it, and we think this is a conservative and prudent until we get further guidance.
So we're actually not on that agenda item yet, Member Eisen. Is it possible for us to just move on to voting on the annual investment plan, and then we'll pick up this item on agenda item 3E?
Sure, that's just fine.
Yeah, we didn't amend the agenda, so I'm just going to keep following it as it's published. All right, so if there are no further questions on the asset allocation review, thank you, Marcia and Matthias, for that very, extensive and lengthy report. And we're going to move on to agenda item 3D, the annual investment plan. Mr. Smith.
Well, thanks, Madam Chair, and appreciate your drawing attention and everything through the macro presentation so far. I'm going to cover just the macro piece and the annual investment plan. And, of course, any questions that anyone might have on the plans for the various asset classes, please bring those as you wish. But I'll just quickly cover the macro part here. Obviously, we've talked in the past few months that the economy's in a difficult position right now, and there's just a great deal of uncertainty out there. And so it makes it a little bit tough to talk about future plans and make forecasts and things like that. But we do an annual plan every year, and so the one that you have in your book today is this year's version. And I'm on page 247. If we want to start there. The latest information from our econometric models, which we have a couple of firms that run these big econometric models, is that the economy here in the U.S. anyway will be down about 5.5%. For the year this year. So one of the nastier recessions we've had, at least over the last 100 years or so. Most of the economists that we follow are predicting that we'll be back into growth mode in the first or second quarter of next year. So we'll have a good jump for the third quarter this year in GDP, and then fourth quarter it looks like we might have a recession number. But once we get into the first or second quarter next year, we should be back into growth mode. We've talked a little bit also about the big disconnect between the economy and the financial markets. That the financial markets have been doing very, very well. The economy's been doing very, very poorly. What's causing that, or what's making that happen, is the big activities, or the high level of activity of central banks and governments across the world. I'm going to focus a little bit more on the U.S. In terms of our forecasts, but a lot of the things that we'll talk about in terms of those forecasts are also happening in some of the other major economies. So we'll try to stay at that kind of a high level. But the difference between the markets doing so well as they have been and the economy doing so poorly is really the Federal Reserve and the federal government here in the U.S. And in the piece, I call them being on a Keynesian rampage. If you remember your economics 201 from school, you'll recognize the name John Maynard Keynes. He was a prominent economist, of course, during the Great Depression, and a lot of his ideas really set into motion economic thinking for the last 100 years or so. And really, at the base, Keynes was big on having governments and central banks substitute for demand when we move into a recession, and then, of course, try to slow demand when things are very, very hot. So that's what's happening today in a huge way, and we've talked about the Fed balance sheet going from less than $1 trillion to $4 trillion earlier this year, and now $7 trillion as of the latest markings on their balance sheet. So just absolute wall of money has come into the economy to support markets, provide liquidity, try to create credit, and of course deficit spending through the government to try to create demand, just to sort of smooth things out. And it's worked. Certainly the number of minus 5.5%, that's what we see for the year, would have been much worse without the current does all this sort of mean for the next 7 to 10 years, which is our investment horizon, at least in terms of the annual investment plan? Well, let's take a look at the three big factors, and that's growth, inflation, and interest rates, and just talk briefly about what the impacts might be on those for that next 7 to 10 year period. And we're on page 248 if you're following along on the text. In terms of growth, we're still expecting a very low growth environment, and it's really a function of two things. Demographics are poor for us right now, and the level of debt that's out in the economy right now. If we break those two down just briefly, in terms of demographics, demographics are very important to how fast any economy can grow, and then of course, summing that up across the world, how fast global growth can be. And right now, across the major economies, we're all facing the same thing, and that's the big baby boom generation having mostly retired, or more than half of those folks have retired, and the rest do over the next 10 years or so. The baby boom was the biggest generation that we've had. 78.8 million Americans are boomers. We're at the peak. We're boomers. We're down to about 72 million today. Still the largest of it's now next to the largest generation, and we'll talk about the millennials here in a minute. But the boomers have been retiring, and they've got about 10 more years, and that big economic force. Not only is the baby boom generation big, but it's also was one of the hardest working, one of the most productive generations that we had in an economic sense. So that big economic force has been retiring here in the United States for several years, and like I say, we have about 10 more years that they'll continue to retire. There's a lot of different numbers that folks put out to what the level of income from someone who's from their peak or earning years to what their income level is in retirement. That number is 60% or less is the numbers that I typically see. So a lot of that economic activity when a boomer retires, drops out of the economy, at least from their contribution. So that big generation's really having a drag, and has been having a drag on growth here in the United States. I mentioned the millennials. They're the upcoming generation. So we have the three active generations of baby boomers, Gen X, and millennials. The millennials just recently just this last year, passed the boomers in size. They're now at 72 million. Most folks, or the people that follow these things closely, think the millennials will peak out at around 75 million. So slightly smaller than the boomers when they hit their peak. Of course, they're still growing, primarily through immigration into that age category of 22 to 38-year-olds. But 75 million is what folks are predicting. So almost a good replacement for the boomers in terms of economic power and ability to produce GDP. But they're still quite a ways from their peak earnings years. So about 15 more years for the millennials to get up to where the midpoint of the millennials get up to peak earnings years. That'll really produce stronger economic growth. So if you look past this 7 to 10 year horizon, another 3-5 years, we can see on the horizon better days in terms of economic growth here in the U.S. The middle generation is Gen X. Folks aged roughly 39 to 55 years old. They're a very small generation. Maybe the boomers just didn't have the number of children that their parents, the silent generation, did. And so they're a very small generation. They also have tended to punch a little less hard in terms of economic performance as a generation. So where that kind of leaves us on the demographic side is the big boomer generation is retiring. The millennials aren't quite to their peak earnings years, and Gen X, which is in its peak earnings years and are the prime economic generation today, is very small and tend to underpunch a little compared to their small weight. So that's one of the big reasons we're getting low economic numbers and have gotten low growth economic numbers for the past decade or so, and we just don't see that being fixed over the the next 10 years. So consequently, we're still projecting slow economic growth. The other piece that's dragging economic growth down is debt. Once an economy becomes as indebted as the U.S. economy is and the global economy in turn, it really starts to slow down on growth. So money that could be used to build productive capacity could be used for demand often has to go to meet interest expense and debt reduction. So that pull of money out of the economy, or at least the ability, blocking the ability of it to go into the economy, will continue to be a drag on our economic growth. So we're really looking for 1.5%, maybe 1.7% real GDP growth on average over the next 10 years. That's half of the level that we had in the 80s and 90s, even into the 2000s. So that will definitely weigh on incomes, stock market performance, interest rates, a whole host of factors will be affected by continued slow economic growth. On the next factor, inflation. This one, Matthias touched on this just a little bit, but the distribution of possible inflation rates really widened out with the monetary and fiscal policy stimulus that we've been seeing. That monetary policy 3, where the Fed basically lowers interest rates to zero, starts printing money to buy securities and provide liquidity and additional credit in the economy, and then also prints even more money to buy current government securities to help fund deficit spending by the federal government. That same thing has happened across the world, in Europe, in Japan, and the other major economies, not just here. So it really widens out the possible distribution of inflation results. So there's a much higher chance that we'll have higher inflation than normal, and we're still fighting deflation, and we've got so much debt. There's a higher probability we could actually have very low inflation or even negative inflation, deflation. So that normal bell curve of results that kind of centers itself around 2 or 2.5 or even 3% has really been flattened with much more probability pushed out into the tails. So much higher risk in terms of our investments and our investment outlook. Very high inflation, tends to damage our bond portfolios. We've minimized those, substantially over the last few years, and have moved money into things that would respond positively to inflation. Deflation, equities tend to do okay unless you get very, very high inflation. So even if inflation went up to 5 or 6%, our equities tend to do okay in an environment like that. Deflation damages everything except for bonds, just about equally. So you just can't protect against deflation. Even at some point, it damages bonds because of defaults. So deflation is really tough for investors. We can handle some inflation, and more so with the current mix in the portfolio. So that's yet to be seen, and really is a much higher risk that we face today than we have, at least in the past 10 years. The last of the big three are interest rates. We've just absolutely been flattened. The yield curve is almost all under 1% across the government curve. Credit spreads are tight, so corporate interest rates are also low. We've seen the housing market just take off here in terms of pricing in many areas of the country. In fact, in my home state of Montana, city Bozeman, where I went to college, was just a small cow town when I was there in the 1980s. I just saw a statistic that the median price home in Bozeman is now $749,000. It's just been a big influx of folks, and housing prices have just taken off. Another statistics related to that are now about 38% of median income goes for a housing expense, which is pretty close to a high. So those low interest rates are driving a lot of the price moves that we're seeing, not only in housing, but also other areas of real estate. Now the COVID crisis has caused, some vacancies and things here in the short run, but there's, once we get back to work, once things start to normalize, we think these low interest rates will hold prices, fairly firm. So the Fed said that they likely will not use what we call yield curve control, but because of the debt in the economy, if interest rates started to rise, I think that very much could be the next tool in their tool bag to use to keep interest rates low across the economy. So for the next 7 to 10 year period, we expect interest rates will be very, very low. So among the big three, low growth, almost assured by the demographics and levels of debt. Inflation has become a wild card and a much higher risk to our investment portfolios and allocations. And interest rates we expect to remain low for the duration of the 7 to 10 year period. So that's kind of it on the big three economic forces. What does this mean for markets? Well, we saw the capital market assumptions still fairly low across the board. We think the poor results from the economy and low interest rates will keep those returns low. The probability they start to increase by a lot is fairly low. So here we are, trying to hit a 7% return target without a lot of options in terms of the financial markets. I was interested in Matthias's chart that shows the Shiller ratio and what you can expect going forward from stocks being at 3 or 4% for stocks. If you think about what things could change with stocks valued so highly, what things could change to actually get a better result. The economy could grow into the current valuations, but I think we've pretty much taken that off the table with the slow growth analysis. We could get a big increase in corporate earnings. That corporate earnings could make up a bigger share of GDP, and that would support stocks. We're almost at a record prior to COVID for corporate profits as a percent of total GDP. Seeing that number go materially higher would be unusual. And then decreases in interest rates support higher multiples on markets. But as we've just talked, we're basically at zero, sub 1% on interest rates. So that's not much of a chance that can help us out. So we're still really looking for those low returns from stocks. That's a basic food group for us. Expecting low returns on bonds because of low interest rates. That's another big food group for us. So straight across the board, we just think the financial market effects of what's happening are almost guaranteeing us some fairly low returns going forward. As Marcia and Matthias pointed out in the run through on the asset allocations, we still expect something around 7 on an average annual basis. I look at both of those numbers, the average annual and the geometric. I tend to pay a little more attention to the average annual as just technically in the models that create that geometric number where we're overstating volatility a little bit. So I think the geometric understates the actual little. So, but we look at them both, and I think still, based on the forecast that we have, we're still pretty comfortable with 7%. Interested to hear any thoughts on that, and certainly could do a study to see if we need to lower our 7% target, at least for land grant. But right now, it looks like it's still a fair number to tell people this is what we think we can earn over the long run. So that's the effects on the financial markets. In terms of broad strategy, a lot the same as last year, folks. We've reduced our publicly traded equity exposure. I think we're down about as far as we would likely recommend to you at 40%. We start moving below that, and we start really having to put a lot more money into the private markets. And we're finding that increasingly difficult as others are trying to do the same thing in terms of getting access to the best managers. And there's a lot of practical reasons not going higher on our alternatives. Makes a little bit of sense right now, at least right now. We've raised and structured lots of liquidity in the portfolio. In fact, I was extremely pleased by the way the liquidity held up for us in the March timeframe. We had more liquidity than we needed to handle those markets, and so you'll see here in a minute we're recommending maybe we lower our liquidity just a little bit. And then income generation, very, very important in a low interest rate, low income environment. Income really halts volatility in the portfolio, offsets equity market risk. Income is quite an elixir in an investment portfolio facing low rates of return, and particularly low returns from the fixed income markets. So recommend strategy, and these are the things that we're going to ask you to vote on in terms of the annual investment plan. I think we should continue to be a little bit cautious of the U.S. stock markets and risk assets generally. Now that's from a longer term, 7 to 10 year perspective. I think here in the near term, with all of the liquidity that's being forced into the economy, we could still see okay markets. Just simply on the basis of deficit spending and huge amounts of liquidity coming in the market, but those things can't last forever. And based on valuations and things going forward, I think there's still a good bit of risk in U.S. stocks and global stocks broadly. And there's a list there on page 252 of things that tend to make stocks do well. I think of those 5, we can only expect maybe 2 to be consistent throughout the next 7 to 10 year period. So tough environment. It looks like for stocks headed forward. Liquidity and flexibility still remain important. That's the second point of strategy for the coming period. So same as we had. I do think we have a little more liquidity than we need. That was proven out. And we'll get to that here on point number 4. In a low rate environment, point number 3, income has much increased value. We just talked that through, that income is quite an elixir in a portfolio against volatility, against equities dropping precipitously. Also being able to make our distribution, certainty in making that distribution without having to sell assets as much. So maintaining that income level in the portfolio is important. I think should be important to us right now. Last, we showed you some mixes that had reduction to core fixed income. Fixed income historically has done 3 things in institutional portfolios like ours, and that's create income, have a drawdown, or have protection against the drawdown in equities as bonds tend to go up in value when equities go down, and providing liquidity. It's fixed income's doing a poor job of all 3 of those right now, even the liquidity part. You have to specifically structure portfolios to get liquidity out of bond markets today, much more so than we had to do in the past. So I think we can reduce an asset class here by a little, 3, maybe as much as 5 percentage points from the 10 that we have now. It's just not doing hardly anything for us other than as a placeholder. And I think we can redeploy those assets in more productive areas in terms of generating income and growth in the portfolio. So that's the main strategy for the next main strategy offering for the next 7 to 10 years. Again, I think we're in some pretty uncertain times here. I think everyone would agree with that. So a broad-based strategy that's based on liquidity and income and diversification seem to be the right strategy, and I think that's what these 4 points wrap up into one statement. So with that, Madam Chair, we'll take any questions that the Council has on the annual investment plan at this point.
So are there any additional, even high-level comments you want to make on the asset class strategies, or you think enough's been said there?
I'll leave those open for a question. I don't think I'd be surprised if anybody saw any surprises in there. We've done several asset class studies here for you the last 18 months or so. So I think everyone's probably up to date on what we plan there.
All right, great. Thank you, Mr. Smith. And so before we take a vote on our 2021 annual investment plan, are there questions from council? With that, I'm ready for a motion.
Madam Chair, this is Member Eisen. Based on the recommendations of the Council Investment Committee, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve the 2021 annual investment plan as memorialized and discussed by the Council at today's meeting.
This is Harold, second.
All right, there's a proper motion by Member Eisen and a second by Member Lavender. Is there any discussion on this motion? Hearing none, if Ms. Siegel could please take the roll call vote on passage of our 2021 annual investment plan.
Commissioner Garcia Richard?
Yes.
Secretary Romero?
Yes.
Treasurer Eichenberg?
Yes.
I'm sorry, I didn't hear that.
Yes.
Thank you.
Sorry, yes.
Peter Frank?
Yes.
Linda Eisen?
Yes.
Harold Lavender?
Yes.
Lee Rawson?
Yes.
Mike Messina?
Yes.
And Nick Reyes?
Yes.
The
Thank you. So
unanimous vote, 9-0.
9-0 unanimous vote on passage of the annual investment plan. Thank you very much. So I apologize, folks. We're going to actually go backwards here. We are on agenda item 3E for the public that's listening in. It's a vote on the asset allocation for the Early Childhood Education Fund. And in our diligence, it's actually back on pages 213 through 217. Marcia actually went over them when she did our asset allocation review. And so if we could go back to those pages, not sure if you've got anything additional, Marcia, at this time, but we're going to also go back to Member Eisen. Had a question for council members to consider based on the guidance that we're getting from our client for this fund. So just a reminder to council members and folks listening in the public, this was an additional fund passed by the legislature in the 2020 legislative session. And it is a fund that's supposed to be invested by the SIC, and we are now voting on the asset allocation of this fund. I'm going to go first to Marcia.
Hello?
Yes.
The allocation was reviewed, and we were the investment committee recommended moving to potential one, which is similar to tax stabilization and the rural libraries, and does have exposure to some higher yielding areas such as non-core fixed income and real estate.
And Marcia, that is on page 214 of diligence?
Yes, 214, and it's under the gray or the green where it says ECE potential one.
Okay, so if all council members could turn to page 214 of diligent, page 67 in the RBK report. That is the potential one is what we're voting on today.
So
30, 22, 28, 20, and 100. Yes.
Madam Chair, it's Vince. May I make a couple of comments?
Absolutely.
Thanks.
Hello?
I think Vince cut out.
So we think,
yeah. There he is.
Yep, sorry. I think in the long run, this portfolio should be invested more in a growth mode than what we're showing you here today. Just based on the distribution pattern that's in the statute, and for distribution, I think a year and a half from now or so, and then the distribution after that, and then a kind of a stable distribution beyond those looks much more like the land grant severance tax funds. So I think in a little longer sense, we'll be back to you with a more aggressive allocation here, one that would include growth asset stocks and private equity and so forth. It's very likely. Right now, we're a little concerned that we'd like to feel like people understood that's going to have to be the case or should be the case, and I'm not sure that opinion exists out there. So we need to talk to folks and make sure folks understand that this is going to be more in a growth mode or should be in more of a growth mode over the longer run in order to meet those distribution requirements. But for now, with the great uncertainty in the economy, great uncertainty in the financial markets, putting this into a 40% allocation to the stock market and another 10 or 15 into private equity and so forth, really puts this fund at a risk. We think over the next year of potential big drawdown and some disappointment among folks that have fought hard to get this fund created. So we think there's a good opportunity for you today to take a conservative approach, sort of try to get the information and the word out that this, we need to be more aggressive with this portfolio over the long run, and then come to you later, likely within the next year or so, with a more aggressive allocation that can, more sustainably meet those outflows. So that's why we're showing you this conservative allocation today. We just think it's the right thing to do, and really want to hear from the council. And if folks think we need to go with a more aggressive portfolio initially, certainly we can come back to you with some mixes to look at, in a higher growth mode.
Thank you for that, Vince. And before we actually take that question that you have or any feedback from council, I was going to go back to Member Eisen with her original question. Member Eisen, would you just repeat your question that you had asked before about guidance from our client?
Basically, we haven't been told by the client what their goal is on this. As Vince explained, we do have some ideas on what the distribution rate would be, but so we are making we as members of the SIC, with our consultants and the State Investment Office's recommendation, are making the decision as to how to allocate this without a client really giving us much direction. I personally feel that this is a prudent way to go, to be super conservative and not have investments in the more volatile investment categories until we get that guidance. So I am definitely in favor of this, but I just want people to be aware that we are making this allocation decision without guidance from a client.
I'll open it up to council if there's anyone who wants to weigh in at this time. Just those on the nature of this allocation and the question that Member Eisen asked for.
Madam Chair, this is Secretary Romero.
Yes, Madam Secretary.
So I think, I know my predecessor was much more involved in the development and the passage of this legislation, and so she understood much more than I do what the intent was and what she had projected as what we were going to be needing in the future. I think, given that I like the idea that we're going with the conservative approach. I think we now have a new early childhood education department. Given the circumstances, given the financial, instability, I think that we're all experiencing right now, I think it's really good that we're going conservative. And I would love to see us engage the Early Childhood Education Department, Department of Finance Administration, and the State Investment Council in conversations on what we think should be done for future investments. But for right now, I think this is a really good approach.
We appreciate that input, Madam Secretary. Thank you. Any other council members? So could I ask just a procedural question? I'm not sure who on SIC staff can answer. Once we make a vote on an asset allocation, how long is that in place for? If we decide, later that we want to come back and revisit this, when is the time to do that?
Vince?
Madam Chair, we can review asset allocation any time on any fund, and particularly funds that are, small relative to our, to land grant. Particularly, we can generally make changes fairly quickly. So yeah, we've got a lot of flexibility to change this. After we have discussions with other folks and kind of build a consensus of a growth fund for this portfolio. We can make that happen on a fairly quick basis.
Are there any other concerns with going forward on this particular allocation recommendation at this time? Does anyone else want to weigh in?
I'm comfortable going forward with it.
Is that number Frank?
Yes, that's right. I'm sorry. And I think the idea of the meeting that you suggested, Madam Chair, is a good idea, and we can bring it back at any point.
All right. Well, if there are no further comments from council members, I think we're ready for a motion on the floor.
Madam Chair, this is Linda Eidson. Based on the recommendation of the Council Investment Committee, SIC staff, and General Consultant RBK, I move that the SIC approve the asset allocation recommended for the Early Childhood Education and Care Fund as discussed, reviewed, and memorialized by the Council today.
Fitzgerald, second.
Okay, we have a motion and a second on agenda item 3E. Any discussion on this motion? Hearing none, if I could have a roll call vote on the asset allocation for the Early Childhood Education Fund.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Peter Frank.
Yes.
Linda Eidson.
Yes.
Harold Lavender.
Yes.
Lee Rawson.
Yes.
Mike Messina.
Yes.
And Nick Baird.
Yes.
Again, unanimous approval for the asset allocation. 9-0.
Thank you. Thank you. Okay, so with the 9-0 vote, we have approval of that asset allocation. Thank you to staff and RBK for that recommendation. Next, we're going to go to agenda item 4A, and we'll get the Chief Financial Officer report from Mr. Shipp.
Thank you, Madam Chair. I'm on page 269. I'll touch upon only 2 slides, and then I'm happy to answer any questions that anyone might have. I just wanted to point out on 269, number 3, we are in the process of distributing the agreed upon procedures report for the fourth quarter of fiscal year 20. That should be distributed to the council by the end of the week, so everyone be anticipating that. And then the appropriation request on number 4, I do note that that was filed by the September 1st deadline. I think Steve mentioned earlier that our budget hearing is on October 29th, and we'll be preparing for that. And then next, if everybody could flip over to page 312. This page is the notes to the IHR. I just wanted to point out, as I like to do, on bullet number 1, you can see what the monthly contribution from the land office was relative to the. It compares it to July and then to the prior August. I think the land commissioner has alluded to in past meetings that the numbers will be coming up. We haven't really seen it come up that much, but maybe in the next several months we'll see some improvements there. And then I did want to point out on bullet number 2, the Tax Stabilization Reserve Fund received $29 million in oil and gas emergency school tax monies. We were notified in May by the deputy director at DFA that a 5-year cap had been reached on that. These monies are recorded 90 days in arrears. So we still have one more month for September that we'll be getting monies in for the month of June. We are anticipating for that month the contributions that we'll receive about $36 million. So the total that we'll receive in this fund related to the emergency school tax will be about $152 million. This is probably, as I pointed out earlier, this is due to a 5-year cap being reached, so I wouldn't anticipate getting these monies in the future. And then on bullet number 5, just because there were some questions raised about it earlier, I did want to note that we are showing the investment or the distribution to the New Mexico Finance Authority of $100 million within the Severance Tax Permanent Fund. We have received no reports for them to date. We probably will have some reports for the upcoming IHR. And other than that, I did want to mention, because I think Linda especially will find this interesting, the only reporting we've gotten from them to date is they are in the process of funding loans of about $17 million of the $100 million. They have not made requests for additional monies as of yet. So I'm kind of curious to see what the demand is for this program. And they have indicated to us that they've already received some inquiries from some of the borrowers that are interested in actually paying off the loan earlier. So that's another good sign to us that potentially, who knows, maybe not the entire $400 million will need to be drawn upon by them, depending upon the demand for loans that they have. And that's all I had, unless there's questions.
Thank you, Mr. CFO. And actually, I'm glad that you brought up this question about monthly distributions from the land office, contributions from the land office. So I just want to remind everyone who is listening in, including council members and staff, that the numbers we report from the monthly basis on the contributions from the state land office actually reflect production from 3 months prior. So these August numbers are reflecting production from May, and we did see a higher than usual differential. So as was mentioned earlier, there is a differential in price between what New Mexico producers get for per barrel crude versus what is on the market at the WTI, because of just the cost of getting the product to the market. But we saw an even higher differential in the May production numbers. And so I'd like folks to kind of keep an eye on this, pay attention to it, and in the next month, we're going to see, an increase in the contributions from the state land office. But that's just kind of a little bit of context on those numbers. We are seeing them start to creep up again.
Thank you, Commissioner.
Any questions from council on the CFO report?
Madam Chair, this is Secretary O'Mara.
Yes, Madam Secretary.
So I've heard a couple of times the statement that there's no reporting from NMFA, and I'm trying to understand, whenever a distribution is made, I mean, it's done by statute. Are there any type of agreements that are put into place between the entity that's receiving the money and the State Investment Council? Or is the money just distributed?
Madam Secretary, that's a good question. We do have a memo of understanding that was entered into in conjunction with the implementation of this program. So I talked a little bit about the lag in reporting. We first sent the initial $100 million effectively at the beginning of August. So they're still trying to get their systems, refined and to the point where they can do reporting to us. So I would expect, August reporting sometime in September. I guess it could be a little bit later than that, but there is a memo of understanding that they will be reporting to us. So as we have only the initial $100 million that we can base any valuation on, when the reporting comes in, the $100 million will be lessened by the loans, and then we'll have to add back whatever loan value that they provide us, which might or might be less than par.
Okay. So, Madam Chair, I guess that gives me some, I feel better about that, because I was under the impression that the money had gone out and there was that we didn't. I don't know that we had an expectation, or I didn't feel like there was an expectation for them to report. And so if it's included in the MOU, is it specific on the timelines that they're supposed to report? And is it just because it's a new program and that's why we're seeing a lag in the reporting?
Madam Chair, I believe I'll have to go back and look at the MOU. There was initially, I think, a timeline of 30 days. It might have been raised to 45 days. So certainly, we're just now reporting on August. So I don't think it's unusual for them, especially with the new program, to take a little bit longer. But I would expect once that they get on a timeline, whether it's 30 days or 40 days or let's say 50 days, that they stick with that timeline from that point forward.
Okay, I appreciate that. I just was under the impression, just that the comments that there was not a reporting requirement, and I'm happy to hear that there is. So thank you very much for that.
Yes, thank you.
Thank you, Madam Secretary. Further questions from council? Thank you, Mr. Schiff. So we'll move to agenda items 5A, any old or new business before the council.
Madam Chair, this is Linda Eisen.
Member Eisen.
Well, with Member Frank being sued personally for his role in the SIC, as well as members of the State Investment Office being sued personally as well, I know we aren't going to be discussing that lawsuit at this time, and I certainly understand that. But this would be a good time just to review what indemnification or protection SIC members have against personal lawsuits against them in their role as SIC members.
Evan or Bruce, does one of you want to cover that? If not, I'll cover it briefly. All right.
Evan, I'd be happy to defer to you. I can do it, or Steve can go first. Sorry.
Go ahead, Evan.
The SIC staff are fully indemnified in two ways. The Tort Claims Act provides indemnification for all tortious conduct alleged in the service of state duties, and our statute has a separate fully indemnification provision. So that should answer your question. But we would be fully compensated from either the state and or the permanent funds, as my reading currently seems.
Thank you. I know this issue came up some time ago, but we have new members since that time. Thank you.
Thank you, Member Eisen. Any further old or new business before the council? All right. With that, we'll move to agenda item 5B. The next SIC meeting is going to be on Tuesday, October 27th. I believe we are still going to be meeting telephonically, but that's all the information I have about that meeting. Next, we'll move to public comment, agenda item 6. And just a reminder for those listening in, because we are not meeting in person, we are taking public comment via email. There is an email address on the SIC website where Charlie receives the public comment and then reads them aloud into the record at every SIC meeting. So I'll turn it over to Charlie.
Thank you, Madam Chair, Commissioner. As you know, and as staff shared with you in the weekly report last Friday, Attorney Victor Marshall has filed a key 10 lawsuit against the individuals mentioned in the discussion just now, including Governor Richardson, Attorney General Hector Balderas, and SIC staff members, as well as Councilmember Frank. So Mr. Marshall emailed our office on Monday and asked that we share his complaint with council members, which, again, we've already done, along with the AG's motion to dismiss that complaint last week. So Mr. Marshall's comment to the council is as follows. We have emailed Mr. Land and Mr. Brown the complaint in State Foy versus William Richardson et al., and asked them to provide it to each of you in advance of Tuesday's meeting. The information in the complaint requires your urgent attention and action because you have an fiduciary obligation to retain new and independent counsel to investigate the complaint. It would be imprudent for you or any fiduciary to continue relying on advice from persons who have provided untrustworthy advice in the past. Independent counsel will be able to confirm the substance of the complaint in a very short time. We are eager to cooperate with you and independent counsel in such an investigation. Regards, Victor Marshall, victor@vrmarshall.com, 505-250-7718, or 505-332-9400. That is the end of his comment.
And that was the only comment received?
That was the only comment, Commissioner.
Thank you. All right. With that, we'll move to agenda item 7. Do I have a motion for adjournment?
This is Harold, so moved.
Got a motion from Member Lavender.
Linda Eisen, second.
All right. With a second from Member Eisen. Any objection to an adjournment motion?
I object. No, I'm okay.
With that, we are adjourned. We'll see you all next month. Thank you.
Bye-bye. Bye, everybody.
Thank you all. Bye.